Welcome to this episode of Dividend Discussion. In this series, I really want to give every dividend investor a chance to tell their story. We're going to get to hear things like when and how they got started, mistakes made, lessons learned, and much, much more. My ultimate hope for this series is for the guest, you the viewer, and even myself to be able to take something away from this conversation to make us all better dividend investors. No matter if you're retired and living off of dividends or just got started yesterday, there's always something to share and even more to learn. So if you're interested in being on your very own episode, reach out to me via email at dividendobsession@gmail.com and I'll be in touch. But without further delay, let's get to the interview. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. My name is Troy and today I have the pleasure of speaking with Jay. Jay, go ahead and tell the people a little bit about yourself.
Hey, Troy, I appreciate you having me on, man. So for everybody that wants to know, I'm Jay, $1 Dividend from Twitter. I'm 36 years old. I started investing in 2019 around the COVID crash, or 2020, I guess I should say, around the COVID crash, and just kind of got inspired by everybody on Twitter to start my own business. Started a pressure washing business and slowly got into dividend investing. I do all types from swing trading, day trading, but heart and soul is pretty much into dividend investing.
That's super cool. So it sounds like we almost started basically at the same time. A lot of people do people hit you with the question of like, oh, it must be nice to start, dividend investing or investing in general during the COVID crash.
Yeah. It
But
was
then
like
they
shooting fish in a barrel.
they're implying that we knew what we were doing when we started. And
Right,
that's the
exactly.
rub. It's like I
Yeah,
was like I went on Robinhood. I literally looked up like the best performer from the previous day, and that's the stock I bought. Because if it
exactly.
went up yesterday, it's got to go up today, right? Like
Oh
that's how it
man,
works.
I was a day trader. Actually turned the stimulus check. That's how it all started for me. I got the stimulus check in, and I flipped that thing to $36,000, and I thought I was, King Kong, and I was
Yeah.
like, oh man, I'm doing great. I'm doing great. And then I heard about this thing called a short squeeze and bought into this thing called GameStop
Yeah.
and made a bunch of money too. I made it even more money, and then I got caught holding the bag and I lost a lot of money really quickly and learned my lesson and kind of set me onto a path of just trying to figure out what other avenues of making money. I've tried everything from options, day trading, swing trading, dividend investing, and all of it. And even right now, I'm learning a little bit about Forex and futures. So, I mean, it's just to me, there's so many opportunities in the market to make money just in general. So, I have multiple portfolios for different types of things, and I just kind of take it day by day and see how it goes. But the long-term goal is dividend investing and just having stuff that just makes me money while I sleep. I mean, I
Yeah.
woke up the other day, got paid, so it's kind of cool.
Yeah. That's the thing that is important to know with dividend investing is like it's not if I don't want to say if you do it right, but if you do it right, it's not going to make you rich tomorrow. But
No.
what you're doing is you're building that passive source of income, which like no matter what other kind of investing you do, I mean, I guess growth investing, like not dividend growth investing, but just growth investing specifically is also passive because that's kind of like a buy it and forget it. But like
Hmm.
that's under the hope and the assumption that one day it'll be worth more than it is today, and then you have to sell it. Where dividend investing, especially dividend growth investing, you can kind of do both. You can buy it with the hope that one day it's worth more, but while you wait, here's some money.
Yeah,
And
yeah,
that's what we try to build is that passive source of income where it's like, oh, okay, today, I made $5. That's no big deal. But, 5 years from now, that'll be $100. And then 5 years from then, it could be $1,000 or whatever it is. So it's
yeah,
really cool to do that. You just wake up one day, no matter if it's a good day, bad day, sunny, rainy, doesn't matter. You're just going
yeah.
to get those dividends, which is great. So, okay. So let me go into the first question. So you started around when I did. So about 2020.
Mhm.
What would you identify as your biggest dividend related mistake so far? And more importantly than the mistake is what lesson did you learn from making that mistake?
I'd say I think it's just pretty common, man, chasing yield
Hmm.
initially. I actually didn't know what dividend investing was. I mean, the first time I ever heard of a dividend was the game of Monopoly.
Hmm. Yep.
You get $10 for the dividend, and okay, well, I don't know what that is. Then you grow up and you start getting into the stock market. I figured buy low, sell high. That's the whole point of the game. And then I was taught options, and I started doing options, and I did an option play on AT&T. And while that option play was happening, I didn't have any idea what, an ex dividend date was or anything like that. And I wake up one morning and I have $267 in my account that AT&T paid me. but I still got to keep the shares because the option play didn't hit or whatever. And I was like, what is this? 200, like, I must have done something wrong here. And I asked my buddy, and I'm like, what is this? And he just starts laughing. Like, it's an old guy that taught me about options. And I end up calling him Mr. Miyagi because he just taught me so many different things. And I'm like, hey, Mr. Miyagi, what's going on over here? And he was just laughing. He was like, that's a dividend, man. And I'm like, well, what is a dividend? He was like, if you own a company and you own it during this said date, they pay you money. And get out of here. Are you kidding me?
That's a
Like, hold
scam.
on. Yeah, that's a lie. So I'm like, all right, let me try it again. So I started looking at different things, and I've got a little spreadsheet now that I look at, and it's so funny because it's like that first year I made some good money. I made like $500, but I was like all in. I'm gonna drop 10 grand on this because the ex dividend date, and I'm gonna sell it the next day, and all this other stuff. And I got caught holding the bag on some stuff. I still own Ford, but I mean, I own Ford because I think EV is where it's going to go eventually, and they're the top selling truck. So I have faith in that company. But
Yeah.
I mean, I think the biggest mistake for me was just chasing yield. Like that's one of the three things I look at is dividend yield, but not on the same factor as like, oh, is it high? Is it super high? If it's super high, I don't even mess with it.
Mhm.
I think Altria Group would probably be the only thing that I would get in that's above like 6%. Um, I've been negative on Verizon for probably like 2 years. I just broke even and I sold it.
Yeah.
And then 2 days later, they had the dividend. And I'm like, man, I could have got at least one more dividend. But I look at the price now and I'm like, well, I would have got the dividend and then it would have tanked a couple dollars below my share price. I'll be holding that thing again.
Yeah.
So it's like I got out of it. Now I've got, $600-700 that I can put that into something that's actually going to make money. Because when you start looking at like AT&T, Verizon and stuff, they all sound good, but when you start actually learning about what dividend is and what the earnings report mean and stuff, take a step back and you're like, Verizon's really not that great of a company,
Yeah.
and it's like, I'm not saying that to anybody that owns it, everybody has their own reasons, but just for me personally looking at it, I'm like, I'd rather put it in Procter and Gamble, put it in Home Depot, something else. Like it's been stagnant at $40 for years. While meanwhile, I could have put that same amount of money into Home Depot and probably like tripled my money.
Yeah.
And it's like there's dividend growth. That's what I think. Everybody thinks, oh, you got a dividend, that's all you want. It's like, well, no, I'm looking for companies now. I'm in the process of just rebuilding. I'm still bag holding Riot. So once I get out of that, that's $10,000 that's going into something else, but it's all about accumulating different things now. So I've got Procter and Gamble, Home Depot, certain things like that that I just know will stand the test of time, that will give me a greater return in not only just dividends, but the actual growth of the company.
Mhm.
You could have a 6%, 8% dividend yield, but if this company stays at $40 for 20 years, I mean, cool, you made 8% on a dividend. That's awesome, but it's the same amount of money you owned 10 years ago,
Yeah.
and it's
Yeah.
just,
I mean, or even worse, and what happens, I would say probably more times than not on like the yield chasing adventure is you put in $100, they'll give you $75, but then the stock price goes down to $60. So like
yeah,
you're like, or
yeah,
I
that's
basically
that's
like,
that's my MPW right now. I put $100 in MPW. I'm down 70%.
yeah, yeah, but
I
good thing
only
they're
put a
paying you
hundred
dividends.
bucks.
Like,
Exactly,
yeah.
yeah,
So it's
and then
one,
they
yeah,
cut the dividend.
yeah. Too often, like, and I think I would be willing to bet at least 90% of people that do dividend investing has had that happen to them, where
Mhm.
they're like, you learn in phases. I think dividend investing, like you learn what a
Yeah.
dividend is. I have a very similar story, except mine's with way less money. So my first dividend was Sirius XM, and that was
Oh
a
wow.
dividend. That was a free stock I got from Robinhood. And I remember I got an alert on my phone one day, and it was just like, "Hey, Sirius XM paid you a penny." I was like, Why'd they pay me a penny? Do
Yeah,
I
what's
owe
going
this to
on here?
somebody? Like, what's a dividend? Like all kinds of stuff like that. And then you like, once you learn that same exact thing as you start going down the rabbit hole. I remember I didn't know what dividend yield was, like, because there's a bunch of metrics on every stock, and like it's
Yeah.
impossible to know them all. I didn't know what dividend yield was, so I was backwards calculating yield, where I was like, okay, if I put $100 into this stock, how many pennies is it gonna pay me? And it was like, okay, $100 into AT&T is gonna give me 7 pennies, but if I put $100 into this one, it's only gonna give me 1 penny. And I was
Yeah.
like, oh, that's not, I was just figuring out like that. And I didn't buy any of these, or I didn't buy this portfolio, but I made like a portfolio in Excel of the best paying stocks. Then I made the ones that are this stock and like all kinds of different
Mhm.
portfolios. and then just decided to go with one of them and ended up switching that. I think it was 36 individual stocks with 3 ETFs. It was like VOO, SCHD, and something else. Um,
Hmm.
but I didn't have a lot of money in my portfolio. So I was like, I'm spreading myself too thin. I had
Yep.
$37 in this stock and $62 in this stock, but like it would have taken forever to see that actually grow. So that's when
Yeah.
I switched my mindset. I was like, okay, I want to have a limited number of companies that I really like. So I think my portfolio right now has 11 holdings. That's it.
That's awesome.
And I
Yeah.
have,
I've done the same thing. I had, geez, probably 40 at one point because I
yeah,
was trying to make my own,
yeah, yeah,
ETF
yeah,
at one
exactly.
point. And it's like, and then I started realizing, I'm like, well, every stock is like $500. Like, I'm not getting anywhere.
Yeah,
It's like just put the money into SCHD for 76 bucks, call it a day.
yeah,
They'll do the hard work. They'll start moving things in and out. Cause that's the thing too. It's like you start having a portfolio spread that large or that thin or however you want to talk about it. It's like you get to a point where it's like, I can't keep up with all these things.
yeah,
If something catastrophic happens, good luck. Which one are you going to start selling first?
yeah,
And then it gets to that point. It's like, just have a couple babies. And that's where I'm at now is like, I have, I have my Raw through Fidelity, or excuse me, my Raw through TD Ameritrade, which is only full shares. So that one I really don't like as much as my Fidelity account where I
yeah,
did a rollover Roth and I'm just fractional. I'm just buying stuff
yep,
fractionally in there. But it's like in my TD Ameritrade, it's like I got $500. Well, I can buy one share. Cool. Like it's one of those I'm slowly turning that into just ETF, and just leaving that alone because those are full shares. Over here on this one, if something's having a good day, I'll buy this. If something's having a bad day, I'll buy this. Just smaller accounts, and I'm still using my mindset of day trading and all that, finding levels. I've heard you explain it all the time. Price doesn't matter. For
mhm,
me, it does,
yeah,
um, because I've been caught holding the bag
yeah,
so many times that it's let me look back. I know the company's great, but there's a ton of companies that are great. So now I've changed my idea of what a watch list is, and I now have companies on there, and I have levels for each of them. Not saying that I'm going to buy at this specific time, but if it starts getting into this area, like I've expanded the area, it doesn't have to be $199. If it's in this general
yeah,
area,
yeah,
then I will grab it because I know that there's a pattern in that chart that happens. And I can see it. That's a great time to buy there, but it might not be a great time to buy here because I did in what was it, 2022, all in on VOO. As soon as I bought that thing just tanked and
yeah,
I'm just
yeah,
sitting
yeah,
there. And I'm like, really? Like,
yeah,
and then I moved to another account and I just started buying fractional shares of VOO. And now that thing is it's great. And it's
yeah,
like, do you put all your eggs in one basket? You can, but when you don't have a lot of money, I think that's what discourages a lot of people from investing is okay, buy VOO because it's following the market. Okay, well the market's down and now all my money's gone and you told me to put all of it in there. But I think now what the great thing is with fractional shares, and that's why I
yep,
try to explain to people, um, get any fractional care an account. I got my wife an account with M1,
mhm,
and she does $30 a week. She has no idea what's going in there. We just picked a couple of companies that she likes, and then I picked a few that I know are going to be good. And I mean, you look at her. What was it? I think it's Microsoft. She's up 120% on that, and it's like just little thing like she finally surpassed me in Target. Like we both own Target and her dividend payment in Target's more than mine because that's where her emphasis is and that's what she starts to look at and it's like and I'm trying to explain to her I'm like she's only done it for a year. Got about 1,300 bucks in there and she's made well over $20 in dividends.
mhm,
She's gained $120 in just growth unrealized gains. And I'm like, if you look at that compared to any savings account, I don't care if it's SoFi
yeah,
or anything, you're not making those returns. And I'm trying to explain that to people. And it's funny that Mr. Miyagi told me the same thing when he was explaining options. I'm like, how do people not understand this? This is so easy. And he's like, because I tell 10 people and only one understand it. He's like, you're that one. So I'm finally starting to realize that 3 or 4 years later that I'm explaining this to people. Hey, just fractional shares. I don't have any money, but you have $20, like $20 a week. Look what my wife did with $20 a week. She's up $120, $20 in dividends, and it's just continuing to grow. I don't have the money. Same thing like we are talking off air. I can't go to the gym. Can't
Yep.
do the okay. Your priorities are wrong.
Yeah.
You'd
Yeah.
rather go out to dinner, or you'd rather smoke cigarettes or do whatever you have to do, watch Netflix instead of spending the 16.99 that it is for Netflix, putting that into an account just once a month. I mean, if you could pay once a month for a Netflix account, you could pay $20 a month for an investment. It may not make you a lot of money, but when you look at it long term and find out what compounding interest is,
Mhm.
man, it's a beautiful thing, dude.
Yeah, it's so I don't know if you've seen any of these yet, but I just started a new series on the channel called Anyone Can Invest, and it's
Yeah,
specifically for that because it's just like I'm taking $60, so it's 12 stocks. They pay me every week. Like once the portfolio gets up and running, they'll pay me every
yep,
week, and it's just the reason I did $60 because it's $5 per stock. I want to make it complicated, so $5 per
yeah,
stock every other week, every time you get paid, and that's exactly what it was to combat. Is like one of the things that you hear all the time in the investing world is like, I don't have enough. Like, I think investing's for rich people or whatever.
hmm
I'm like, no, investing's not for rich people. Investing makes rich people. Like
yeah.
that's what
That's
happens.
that's where the whole name for me when I decided to get on Twitter. A dollar a day changes. Apple a day keeps the dentist away. A dollar a day keeps that 9 to 5 away,
Yeah,
man. Like, just start doing it. And that was my goal. My first initial goal was just to make $1 a day in dividends and just make $365 a year.
yeah,
I finally done that, and now I'm like $4. What am I? $4 away from making $50 a month,
yeah,
and it's like that was it was so hard to get a dollar a day. I mean, just penny. I remember just posting up on Twitter in the initial, oh, I got paid 2 cents, and
yeah,
now you start looking at that chart, and it's like 2 cents, 4 cents, 8 cents, 12. Just keeps going and going and going. It's like, and I'm not doing anything else. I'm just
yeah,
reinvesting those dividends.
yeah.
Like, and
People
it's
are
just
people are
it.
always so like anybody that you talk to about dividend investing that's like skeptical of it or just investing in general that's skeptical of it is like when you first start in dividend. I mean, I'm sure you've seen the picture online where it's the life cycle of a dividend investor where you make your first dollar and they're like, oh, good luck with that. You make your first, $5. They're like, oh,
Yeah.
congratulations, whatever. But then you start making like 100, 500, $1,000, and people are like, well, how'd you do that? And you're like, remember when you were making fun of my 10 cents I got? Like that's how I
Yep.
did it. And like what I always tell people, I tell people all the time in my monthly recaps, when you first start dividend investing. So this is really good for like maybe not you as much, but for sure your wife, since she's not into it and like it's small amounts that she's getting, like $20, whatever. Have a spreadsheet. So it's very important to track. We'll get into this later in the
Mhm.
video, but like have a spreadsheet and track the growth from one dividend to the other in percentage because the
Okay.
dollar amounts are so small. So I tell people this all the time. When you first start, focus on the percentage, the growth from this dividend to this one. Yeah, you only made $1, and then the next time you made $2.15, but that's like a what 115% increase. Where are
Right.
you going to get 115% return? Nowhere. You're not going to do that.
Yep.
And then once that percentage starts to drop, like it inevitably will, you're not going to make 115% all the time back to back to back. Once that eventually drops, switch your focus to the dollars because then the dollars
Mhm.
will start to be bigger. So like I'm
Mhm.
starting to do that in my portfolio where it's like I'm still making like I'll go from January to January and be up like 1,000% from like
Yeah.
last January to this January, just because like contributions, dividend raises, stuff like that. That's not sustainable. I'm not going to do that for the next 21 years. Like that's not going to happen, and I know that. But like this January, or like say last December, I made like $290 or whatever. I'm not
Mhm.
expecting to double that this December, but now say next December, say December of 2024, say I make $400. Okay, yeah, I didn't go up whatever percentage I went from the last one, but now I'm making $400 a month in December. Like that's cool. Like
Right.
now you can focus on that. Like, hey, that's Christmas shopping. That's this bill and this
Exactly.
bill and this bill. That's a grocery bill for a week or whatever. Like you can start switching your focus to that. Obviously, it's preferred that you leave it in there and don't pay those bills with it, but like just knowing that you could is the
Yeah.
motivation for that. So,
I think that's the like, once you get to that point, say like the 290 and stuff, it's just peace of mind knowing that if I don't touch this, 290 every year, no
mhm,
matter what.
yeah,
I mean, and it's like if you're picking the right companies,
yeah,
and you're not picking an MPW that's going to cut their dividend, but it's, like let's use example for Facebook. They just started their
mhm,
dividend. That's got me a little weary, that billion-dollar company that just all of a sudden now wants to give out a dividend. It's great for all the shareholders. I think that's awesome, but I think of it more of like a Disney. At the first sign of anything that happens, or they want to spend a lot of money to buy these four other apps, that are doing better than their app, maybe what are they going to have to do? They're going to have to cut the dividend, or they're going to have to do something else. So it's like everybody just jumps on board because, oh, you have to have a dividend. Like, I'm a firm believer in Tesla, even
Mhm.
though I have a love-hate relationship with that. Like, I think that company will do great things. They're in the forefront of a lot of things.
Mhm.
I'm invested in them not because they have a dividend or they don't have a dividend. It's the fact that I like that company. I see the potential in it. When I look at something like Facebook, I don't see that 20 years from now. I don't see it being the same exact company. If TikTok takes over or what, I mean, that perfect example, TikTok. I mean, now everybody has shorts and reels and all these things. Like, that wasn't your idea. That was somebody else's idea, and you're adapting to that.
Mhm.
Good for you. But 20 years from now, is Facebook still going to be Facebook? I don't personally think so. So
Yeah.
I don't use that as an investment to get in. I didn't buy into it to get into the dividend. Like, to me, it's one of those swing trades. Like,
Yeah.
I'll buy it now, and like the other day, it was easy money. Like, oh, great earnings. All right, let's let it ride. Boom, sell it the next day. Like, okay, I'm going to use that money to buy an actual company that I believe
Yeah.
in.
Yeah. I mean, with Facebook, I think the hard part, or Meta technically, but I feel like the hard part with that is just like you're saying, like what else do you do? Like
Right.
Tesla doesn't just do cars. Like they do a bunch of
Correct.
other things. So like what I mean, Facebook's tried like the AR, VR, whatever you want to call it. They've tried
Hmm.
like the different stuff like that, and they keep shutting down those programs. And they have the year of efficiency where they cut a lot of employees and stuff like that. Like, okay, they've tried to pivot. The pivots didn't work. So like what is next? I mean, the
Hmm.
good thing with them is like they just started this dividend. I think the yield's like 0.5%. I don't know
Yeah.
what the payout ratio is, but it's probably not high. So like it's one of those things where like I think they are a long way away from having to cut a dividend, because to me,
Right.
like, and we'll get into this later, but like my criteria when I select stocks is that you have to beat the S&P 500, you have to have a dividend streak of at least 5 years, and you have to have a 3, 5, and 10 year dividend growth rate above 10%. Those are the things that I
Okay.
look for. But the reason I look for that 5 year streak is because like that shows me that like you've been through some stuff. You're going to pay
Hmm.
a dividend, and you would think and you'd hope that Meta looked at this like, okay, we're not going to just start this dividend without like trying to forecast some years down the line that make sure we're not starting a dividend and the next year we're cutting it or eliminating it. Like that wouldn't be a good look.
Yeah.
So like you would think, I mean, maybe that's giving benefit of the doubt to somebody that doesn't deserve it, but like I would hope that a company like that's that big would be like, okay, we're going to start this dividend. Cool. If we're going to start the dividend, how much are we going to pay? By paying this much, like what's our plan to grow that dividend? Do we plan to continue to pay that dividend for years and years and years in the future?
Hmm.
Like one of those, but for me, unless it goes into one of my ETFs that I own, I'm not going to own Meta as a dividend growth stock until it gives me those 5 years of thing. And then I can actually look back. I'm like, okay, it's paid and growed for 5 years.
Right.
It has a 13% dividend growth rate or whatever it is. Maybe it pulls a Tootsie Roll or a Realty Income and it starts growing its dividend minimally just to stay on the list. And like that doesn't
Yeah.
do it for me. Like I don't
Right.
care about Realty Income's 2% dividend growth rate. Like that doesn't do anything for me. Cool. They're
Yeah.
keeping like I just had a discussion on Facebook with somebody like Realty Income. I feel like they have the game so wrapped up
Oh, they
around their
got me.
finger. They
Yeah.
they market themselves as the monthly paying dividend stock. There's a bunch of those. They pride themselves on raising their dividend quarterly. If you go to Seeking Alpha and look at what they raise their dividend by quarterly, it is literally fractions of a penny.
Right.
They'll go from 96.25 cents to 96.3 cents. Like
Yep.
where you spending point 0.3 of a cent? You're not. So, but
Yep.
it,
Preach,
obviously, the more
baby.
shares you own, the more that turns into actual cents. But like, they're just doing that to give themselves something else to put in their cap. Oh, we've grown and paid and grown our dividend for this many years, and we've raised it this many quarters in a row. Cool, yeah, you're not wrong. But like, when you actually step back and look at it, okay, you're raising your dividend at 3.5% over the last 10 years. Like, cool, I can find 100 other companies that do that better.
Yeah, exactly. That's it. I mean, a perfect example of a company that's going to be a Verizon for me. Once I get to a certain level, I'm still buying into it. It's not a bad company, but it's one of those after I've taken a step back, started looking, I'm like, okay, well, I got so much money in this company and it's
Mm-hmm.
doing nothing. And
Yeah,
it's cool. It's paying me $27 a month or whatever it is. And it's like, that's awesome. But in reality, I'm trying to think long term, man. And it's like, and I think you just learn that over time as an
yeah,
investor, as it just with anything. And it's like, I definitely think I might keep a little bit
Yeah.
or buy it a little bit later on or something like that. But it's like you've got Vici, you've got, I mean, AMT is one that I'm in that I actually like because that's gonna go with, cellular, and
That's
it just,
American Tower, isn't it?
yeah,
Yeah.
yeah, and it's like to me that's it's it. I haven't really done the exact research that I need to do on it, but it's one that I hold. I don't hold as much, but whenever I joined the fire department, when we were talking off air, I wasn't going to be on Twitter and I wasn't going to be paying any attention to anything. So I just put all my money into O and I just let it ride because I
Yeah.
know it pays monthly,
Yeah.
and I made some money, but it's like whenever I left the fire department and I wanted to get back on Twitter and start doing all that, I was holding the bag on O for a couple months,
Yeah.
and it was like, cool, now I can't invest in anything, and it's like because I bought it all in at $60, and now it's at 52 and it stays at 52 forever.
Yeah.
And it's like, but you live and you learn. And once I got to that break even, I figured out, hey, let's move this to somewhere else. I kept a little bit into it and then started progressing and started moving elsewhere.
Yeah.
But
I mean, there's so many different. So I'll talk. By the time you guys are seeing this video, you guys have already had the opportunity to watch my January recap, so it's not going to be a spoiler alert. But for you, Jay, it will be a spoiler alert. So in my January recap, I talked about like a new strategy that I have. So I only have 11 holdings, like I told you. I have
mhm,
two holdings that don't meet one of my criteria, and I argue it's my most important criteria because I invest to make more money. So to me, if there's going to be something as simple as the S&P 500 and you're not going to outperform that, I don't want to put my money into you because I could just do the market instead. So two of my holdings, which are Starbucks and ExxonMobil, over the past, I just ran the numbers at the end of last year. They're not in the last 10 years outperforming the market. So I'm starting a new thing in 2024, and you might be able to do this too, where I'm not selling them. I'm just turning them into what I'm calling dormant positions,
yeah,
where I'm going to let
yes,
the dividends reinvest. I'm not adding any more money, but I'm not going to sell it because like I bought those companies for a reason. And just
yep,
because currently they're not meeting my metrics, they might meet my metrics next year when I test. And if they do, like say they have a really good year, I'm still going to get those gains from them having a really good year because I still own them. And now they're back on my radar for me to start adding again. So
yeah,
I'm just going to do that. So I'm going to have my 11 positions. Um, I'm trying to decide, like, it's my first month doing it. So I'm trying to decide if, like, okay, do I want to try to identify another company or two that I can make active positions and always have 10 or 11 active positions in my portfolio, or how I want to do that? But right now, for this month, for January, I literally just said, okay, I have 11 holdings. Only 9 of them are visible to me because, like, I pretend that Starbucks and Exxon don't exist. I'm
right,
putting all of my money into these remaining 9 holdings and keeping them going because they met all the metrics I needed them to meet, or
yeah.
specifically outperform the market. That's the one I care the most about. Like
I think
Apple doesn't technically have the dividend growth rate that I like, but it's Apple. Like Apple's
right,
done more than outperform the market. It has a dividend streak, and it's still raising its dividend by like 6, 7, 8%. So it's
right.
still raising more than inflation, in addition to the however much percent year over year growth they're going to give me as a company. So I made some sacrifices, but to me, not outperforming the markets, that's the straw. Like I can't do that one. Like if
Yeah.
you're not going to do it, like I don't know why
I
I'm
mean,
owning you.
I totally agree. I mean, that's what I did. I mean, that's why I was bag holding Verizon for so long. I like on my M1 account, I had everything set up, and then that thing went all the way down to 1%. Like I
Mm,
was like, I'm not putting any more money into that. And you always hear a lot of YouTubers and people like influencers or whatever, like, oh, just keep buying it while it's low. It's
mm.
just keep buying. Spending all my money on something that's not going anywhere. That's not the greatest financial advice. And I know there's no financial advice, but
Yeah,
it's like when you're listening to 7 hours of YouTube, that's financial advice. I don't
yeah,
care. Just you have to cover your
yeah.
bases
We have
and
to
say
say that.
those
Yeah, yeah,
things.
yeah,
Yeah, I
yeah.
mean that's all it is. But it's
It
like,
is interesting that you bring that up too, because like I literally had that thought because for Exxon I'm up. Like Exxon's like I think my fourth or fifth best performing position in my portfolio. So it's like it's not even like Exxon's sucking for me. I'm not going to buy any more of them. Like
right,
no, it's just like over the course of the 10-year period that I just looked at, they didn't outperform. So I'm going to put my money somewhere else that does. So
right.
I'm up on Exxon. Starbucks I'm down like 4%. So it's the same exact thing. And I don't think there's a right or wrong answer, which is exactly what you were just talking about. Like somebody could argue, okay, Starbucks hasn't performed over the past 10 years. If you think it will outperform, which I clearly do, that's why I'm still holding it, why not buy more Starbucks now that it's lower? But I'm like, that's how you end up getting into like what I'm going to call them traps, but like the traps that
Yeah.
people get into with MPW or Zim or AT&T or
Yeah.
Verizon, stuff like that, where they're like, oh, eventually this one will come back. Well, it also eventually might not. And then in the meantime, you're, dollar cost averaging down, when in reality they call that catching a falling knife. Like you're just like, oh yeah,
Yeah.
it'll stop falling eventually. I'm like, okay, or will it? Like people that
100%.
fell for that the yield max stuff. When I made my video on that, I got a lot of backlash. Like, oh, I just don't understand whatever. I'm like, literally buying whatever stock it's covering will do you better, whether it does or doesn't pay a dividend. Like Tesla or TSLY, everybody was excited about the 60 something percent yield. I'm like, cool. Now look at it. They were buying it at
Yeah.
$17. It's like $9 now. I'm like, it's just going
Yeah.
to keep losing value. That's what's going to happen over time.
Yep.
They're like, oh, in down markets, it'll do good. And in up markets, it won't do good. I'm like, okay, but like, look how long bull runs last versus how long bear markets last.
Right.
It's
Yeah, if
not
you look at the
proportionate.
grand scheme of thing, I mean, it's like there's been 20 bear years and the
Yeah.
rest are all bull years.
Yeah. I'm
Like,
like,
I
okay,
mean,
so
it's
you're
like,
going to hold this thing hoping that while you hold it, we're going to have a bull or a bear market
yeah.
in the effort when knowing that
And then
98.
what happens with all the rest of your other
Yeah,
money too?
exactly. Yeah.
And all
Yeah.
the other stocks so they're gonna go down too.
Yeah. Yeah.
Like,
It again, it's the yield,
mhm.
and one thing, in addition to like getting your wife to focus on the percentages instead of the dollar amounts when it's really small, because like that helps people, especially that aren't super into dividends like we are. That really helps
Mhm.
switch their focus. Like, yeah, you only made $22 this year versus, or say she makes $30 this year instead of $20 last year. Like that's not like, oh yeah, an extra $10, $30 a year. What am I going to do about that? But then you hit her with the percentages. Like, oh, that's like
Yeah.
a, what is that, a 66% increase? I'm not good with percentages, but like I do my
Yeah.
spreadsheet for all that. But like 66% increase. Like show me something else that you're going to make 66% more on. You're not.
Yep.
So like
Yep.
that's where you trick. But what I say with the yield max stuff is like so many people, whether they're your age, my age, younger, older, doesn't matter. Unless you need the dividends today, why do you care what they're paying you today? Like
Right.
you're just
Yeah.
trying to build the portfolio. People think I'm joking when they're like, "Oh, today's a red day. What do we do? Yo, woe is me." Whatever. I'm like, I hope we go down 99% today because I have a lot of.
Yeah.
I need to put money in the market. I don't want this stuff to be as expensive as it is. You're telling me I
Yeah.
can get Apple for 10 cents? Sign me up.
Yeah. All
Like
day.
I don't care. And they're like, "You don't mean that." I'm like,
Mr.
"No, I
Miyagi used to
do."
say, "Back the truck up."
Yeah, exactly. Like, give me
It's like,
all that. I'm using my emergency fund. I'm using
yeah.
all the money I can to get these companies I want if they drop 99% tomorrow. Like, that's what I'm doing. So,
I think what you're doing is great though, because you think about it, it's like Starbucks isn't going to go anywhere.
mhm,
Oil's not going to go
yeah,
anywhere. But right now, like we were speaking off camera, it's all about priorities.
yeah,
Right now, the priority is not putting the money into Starbucks and Exxon.
yeah. It's
It's
just
moving to where,
opportunity cost. It's not even that
yeah,
they're bad investments. It's I think that something else is better right now.
right now.
Yeah,
And then 5 years from now, all of a sudden, we'll have the same exact conversation. I'm like, oh, you're still invested in Starbucks and Exxon. Oh man, I'm dumping back in the truck up, baby,
yeah,
because this is
yeah,
happening. It's like, because right now is when you need to be doing this. Right now is when you need to be doing that.
mhm,
Like, and it just, I think people are so afraid to pivot and so afraid to make rebalances and start looking at things. You don't have to sell, but take that rebalance and start looking at things. Okay, well, this year we're not going to invest in Verizon. I personally got out of Verizon. I
mhm,
keep bringing that Verizon up, but it's like I just don't not it wasn't doing it for me. I can see the growth elsewhere. I don't feel like I need to chase yield. I want to have different companies. My mindset is different. My priorities are different. So I do still have Verizon in my M1 account, but I've only got probably like 4 or 5 shares,
mhm,
but I'm going to keep those because it's gaining me 7, 8%
yeah,
dividend, but it's at a 1%. I'm not putting any more money into it. It's just going to sit there dormant until one day Verizon buys AT&T or
yeah,
something like that. Something crazy happens, then we're going to start shoveling some money in there.
yeah, yeah.
I think what you're doing is great though.
Yeah, and like I said, it might. You watch this video in 2026, maybe I'm doing something completely different. Who knows? But like
Yeah.
we talked about, it's all about pivoting. So great segue. Speaking of pivoting, how would you say your investing style has changed from when you first started investing to now?
Uh, it's so what I'm interested in is different, and where I find the research for me. I think at first it was my research was just people on YouTube, just kind of listening to whatever, buy into this.
Mhm.
I bought into, and I'll be a man enough to admit it. I bought into Vici, not really understanding it, just because it was the big YouTube video at the time. I sold Vici, but now I want to buy back into it because I've
Yeah.
actually done the research on it. And it's like, I just didn't, I just kind of followed, the herd. And as a person that I think of myself as a leader, that's kind of annoying because I just follow the herd. But I feel like there's so many people out there that do give it the time, like yourself and other YouTube channels that put in the time and the effort. So I do trust their opinion, but I think as I'm getting more experience with the dividend investing and just investing in general, is that doing your due diligence
Hmm.
is very, very important, because what's important for you is not necessarily the same importance as for me
Hmm.
or somebody else.
Yep.
And Jeppy is a big one. Everybody bought into Jeppy. I got a couple of shares of that, and I was just like, you know what? FCHD does a lot better for me. I can see where I like those companies. I like what this is doing. Everybody was just chasing this yield on that thing too. It's not a it's not a bad play, but just for me, after doing my due diligence, I moved that money over to SCHD,
Hmm.
and it's just, I feel like, or just being repetitive with things. A lot of people will have, you'll have one thing in a Fidelity and one thing in a Vanguard. And it's the exact same thing. And it's like, well, just combine your money in here, have more shares in this one,
Yeah.
and it's just kind of taking the time to look at what I want to invest in. I'm still a swing trader. I still like to do that. I like easy money. Who doesn't? But I have separate accounts for those now, instead of having all my accounts combined into one, you know, and turning a stimulus check into $36,000 and then looking at it 2 years later and it's worth $4,000 because I was an idiot.
Hmm.
It's all learning lessons, and I think that's just, as you get older and as you start getting more experience with your investing, you kind of just change your ways, and that's how I've been. It's
Yeah.
just
Yeah.
adapting as.
I agree with all that. It's the like you people that pretend that you're going to come into investing from knowing nothing. Like to me, this is a bad sign. If you come into investing and you know nothing, and then 5 years later you have the same style, I think you're doing something
Yeah,
wrong. Like you admit you know nothing
yeah.
when you start, and then there's no changes. Like you're almost so wrapped up on that you know you did it right the first time kind of thing that you're afraid to pivot or whatever. To be I don't know. It just doesn't make sense to me. Like I've changed my portfolio so many times now. One thing I am doing is like I also realize that some of the most of the best performing portfolios are people that are dead. Why? Because they don't touch it.
Yep.
Like they just leave it alone. Obviously, they're not there to do
Hmm.
anything. So like it's one of those things where it's like, okay, how long do you give an idea before you're like, hey, I need to like reevaluate this and pull the plug on it and try something different. Because
Yeah,
like
I think that's something that I struggle with too. Is I've rebalanced the portfolio so many times. Is now getting to a point where it's like, are you sure you want to rebalance
yeah,
this time?
yeah,
Because every single time I do, like, let's use Meta for example. I bought Meta when it dipped down to 240, and then when I bought it, of course, it dipped down to $88
yeah,
throughout the year. I sold it at 241 just to break even, and now you look at it now, and it's like, you know, you live and you learn. But it's
yeah,
like I feel like constantly doing what I was doing and constantly rebalancing. I think that has a detriment too, and it's just sitting down and actually focusing on just a few, the core. Make your own Magnificent Seven,
hmm,
and just start with those, or if you don't have the time, put it in this something like VOO or SAHD that has a history of returns. And when you actually learn what you're doing, then you can start branching off. Maybe you have VOO, but you also love Microsoft. Like, that's one I'm always going to have in my portfolio, but I have VOO too.
hmm,
I just feel like that company is going to just stand the test of time, and I would like to see those gains more exponential
yeah,
than what VOO is giving me,
yeah.
and it's.
Well, what you were talking, I was trying to remember when I was talking just now. I was just trying to figure out what the heck I was trying to say because you said something earlier that I thought was really interesting about like you having the like follow the herd mentality, but it's only in investing
Mhm.
when you first started. Like you're not like that in real life, and like you can quite literally like you can pull back trends from every year. So I feel like in 2021, maybe even in 2022, no, 2021 for sure SCHD was all the rave. It
Yeah,
was everybody, like you couldn't go anywhere on investing internet without hearing
yeah.
SCHD. And then in 2023, it significantly underperforms the market. Everybody's like, oh, I'm looking into DIVO or whatever some of these other things are. Like nobody like SCHD anymore and stuff like that. And like that's where the market makes its money, is by people doing that thing where they're like, oh, this is a good thing. Oh, it had a bad year. Let's pull all our money out of there. Maybe take a loss. Then we'll put our money over here, put some more money into that. Maybe that doesn't have a good year. And you're just like constantly chasing the next bucket, trying to get on the trend. But just like with GameStop and like some of these other meme stocks, what happens is odds are you're not in the beginning of the trend. If you're lucky, you're in the middle of the trend. Most of the time what happens is you're at the end of the trend, and then you get caught holding the bag like you said you did. Yep. So it's one of those things. Like it's just so many, like you don't have to worry about trends when you just buy and hold. So like the reason I adapted this like active and dormant position strategy is, I've said this in several other interviews, but like my position that I had with NVIDIA is I had NVIDIA, I bought NVIDIA, it was more expensive. Then it went down and I kept buying it because I was like, okay, so this is like a two-pronged thing. I bought it because other people told me about it in the dividend groups I'm part of on Facebook. And I didn't really know why I was buying it. Everybody was just talking about NVIDIA. I was like, okay, cool, I'm going to buy it. It went down. I kept buying it because everybody kept talking about it. And then NVIDIA started going back up. It was one of my best performing stocks. I was up like 55%. Sold it because it met some of my metrics. It outperformed and it had but that's all it did. It didn't raise its dividend and it didn't pay it year after year growing. So I was like, okay, I'm going to sell it. So like that would be a thing where like now I wouldn't have sold that because it met my most important one, was outperforming the market. I would have just turned it dormant because 3 days after I sold it, they had earnings and went up 24%.
Yeah.
Of course, why not? But like I said, I lived and learned, because what I did is I sold that. I put all that profit. I rebalanced my portfolio by increasing all the other positions of those. And I also started a new position in Costco. And at the time, you're obviously, again, spoiler alert, but anybody else that's watching this now, if you watched my recap video, Costco just paid a special dividend. I got $99.11 from Costco this month.
Nice.
As a special dividend, like $15 a share. I almost had 7 shares. So it was one of those things where like, yeah, I would like to still own NVIDIA. I think NVIDIA is going to do things. It didn't meet my criteria at the time. If I would have turned it into a dormant position, I would have got all those things. Yeah, I wouldn't have had a lot of money to start Costco, but I could have taken any money that I was going to put into NVIDIA and started Costco with that. Maybe gotten less of a special dividend. Costco is now my best performing position. Like, it's just one of those things. Like, as I've learned, I've made some mistakes and I've adapted to those mistakes and like tried to figure out like, okay, I learned that lesson. I'm going to try to adapt it here. Maybe that fixes that part of my issue with my investing style, but maybe I starts a new one and I have to figure out that and learn from that one. So really the idea is that you want to learn these mistakes while you're new and while your portfolio is small. Cause it's, if you lose 10% of your portfolio when it's only $1,000, like, okay, yeah, cool. You lost $100. But if you don't learn any mistakes and you keep making mistakes, 10% of $1 million portfolio is $100,000. That's a little bit, hurts a little more. So still 10%, but it hurts a lot. So yeah, I agree with everything you were just saying. And the second prong of that thing I was saying is like what you were talking about, like when you first started and you were just buying things that people were talking about. Obviously that's not a good thing. Obviously do your own due diligence. Like you said, what I have goals for my portfolio might be different than yours. Mm-hmm. The other thing that does is when you buy a stock because you heard about it on Dividend Obsession, you don't do your own research like I tell you to do. When you do that and that stock goes down, you're more likely to sell because you didn't have any conviction on your own of why you wanted to own that stock. That's what happened with me in NVIDIA.
100%.
One I still own is APD, not ADP, APD, which is the Air Products and Chemicals. I watched a YouTube video on that a while ago and he hyped it up and made it sound really good. That was the extent of the research I did. That's it. And I still own it and it's like my second worst performing stock. Now I'm keeping it because it still meets all my metrics, and I think I'm buying down. It still meets my metrics. It's still hold and serve. I'm going to hope that in time it comes back up. But yeah, it's just one of those things. Like it's really important to do your own research for that reason. Because if something goes down, you want to be like, oh, I don't want to trust Troy from Dividend Obsession anymore because he gave me these crappy stock. Well, I didn't give you a crappy stock. I put a crappy stock on your radar, and you bought a crappy stock because you didn't do your own research. Exactly. Now I try not to be like the other channels and give you crappy stocks in general. Like I said, all the stocks I recommend.
That's the thing. You're not a fortune teller though.
Yeah.
None of us are. I mean, and that's the thing. And it's great that you're open and honest that you make mistakes. You still made that mistake to this day. And that's the thing. I think people, it's that Instagram effect that everybody just wants to show the best of the best. I remember posting when I made $5,000 in 15 seconds on AMC. man, you know, I could have started a YouTube channel that day, probably had 1,000,000 subscribers.
Got a big watch
You
and a
know?
Ferrari, like just
Yeah,
yeah.
yeah, absolutely. Yeah, look at me now, man.
Yeah.
Like all that money went away and then some
Yeah.
because I was like, oh yeah, it's you know, it'll bounce. Keep on HODL, hold. You know, apes, we're gonna do. No, you're not. You're still bag holding. You
Yeah.
know, and I held that thing down to $4, man. Back to where I originally bought it the first time before I sold it. And I took a huge L. And I just remember sitting there that one day. And it's just like the movie. If you watch that movie just came about the GameStop, it's
Mhm.
like they're just looking at the button. And I was like, you know what? What could I've only got $3,000 left in it. It's worth probably 50. You say I had I think I had 10 grand invested. It was worth 3,000. What can I do with this $3,000? We're going to sit here and hope that it goes up to $10 maybe, or maybe it gets anywhere near 30 something dollars. Never going to happen. It may, but the amount of time that it's going to take
Yep.
for that to happen, or do I just take the $3,000 now, flip it, and let's start making money? And that's what I started
Yeah.
doing. And sometimes you just have to do that. And you have to, I think with the importance of any stock now, one thing that I have learned to kind of circle back to that question is stop losses.
Yeah.
You know, you have to have an out. You have to have an exit strategy. If you're just going in blind, you know, and following these rules, you know, my rule now is when I did the rollover 401k to the Fidelity, now that I have fractional shares, I'm not going to buy 100 shares of everything just so I can do option plays.
Mhm.
You know, if Microsoft is having a bad day and I see it drops 3%, I might buy 2 shares because I know that in a couple of days it's going to go back up 3%. I can flip that. And then I use that money for something else. Um, but the moment I go and I buy, like I still, 2 weeks ago, you know, or a month ago, I did it with Bank of Nova Scotia. You know, I was like, oh man, I'm doing pretty good. I'm gonna buy 100 shares. As soon as I bought 100 shares, it tanked, and I'm holding it for 2 weeks. And it's like, you broke your own rules. You deserve this,
Yeah.
Jay. Like that's exactly what you get.
Yeah.
So every day I walked in, I'm like, cool. I can't trade futures. I can't trade forex. I can't do anything. I just get to see her go on Twitter and just you know, just kind of look around, like with my thing in my hand, just hanging out,
Yeah.
waiting. But
Yeah.
it's like, follow your rules, have exit strategies, even if that is for a dividend, you know. Go back to Disney. I mean, Disney's a great company, but if you're only in Disney because of a dividend, well, they're notorious for taking that away from you.
Mhm.
So, is that a company you want to stay in? Do you believe in the company? If you do, then stay with it. If not, have an exit strategy. As soon as that news happens, go, get out, take your profits and move it to something else.
Mhm.
If that's where your portfolio needs to go,
Yeah.
I don't think people do enough of their own due diligence. Just like I think you're guilty, I'm
Mhm.
guilty, we're all guilty.
Yep.
But
Yeah, it's my and I mean one of the questions we can just get into it now. So like one of the things is like I developed that criteria because like I don't know, like I don't dig into the balance sheets and all, I don't, it just doesn't make
no,
sense. Like even when you start to like read it and you're like it'll say like in billions and then it's like 89,909. I'm like okay,
yeah,
like even like that stuff's hard. I mean, maybe if I looked at it for 10 minutes and did a couple of them a day or whatever, I'd get used to it. But like my thing is when I made my criteria, going back to what you're talking about, like with your due diligence, is like I wanted to make criteria that I could understand and
hmm,
I could follow because that's the most important thing. Like, yeah, it's cool to have a criteria, but if you're not going to follow it, what's the point of having it? So like I wanted to make
right,
one that I understood and I could follow. But more importantly, I was like, what of all the people I consider to be smart people and their investors, what do they buy? Why do they buy it? And how can I make my criteria encompass some of the stuff that they're looking at without looking at that stuff? So like one of the
hmm,
guys I look up to in the dividend investing world is Joseph Carlson. I think he's really smart.
hmm,
He knows a lot more about stuff that I don't even know what he's talking about. But like he explains some of the stuff. Like when he gets into like all the numbers and stuff, I'm like, yeah, like he sounds smart to me, sure. But like
yeah,
when like the thing that I like is when you watch my Power 5 series or when you watch some of the other stuff, we get to the same answers. We just do
right,
different. We show our work differently to get to those answers. So like that was one of the things that like helps me feel good about my criteria is like, okay, he's looking at free cash flow and this and earnings per share and all these numbers and stuff like that, which I feel like there's a lot of different ways to manipulate a lot of that stuff, which is different topic. But like all of that comes out to if you meet those things, you typically are able to pay and grow your dividend. You're typically able to do it at a pretty good rate, and you're typically outperforming the market. Cool. I don't look at any of that stuff. Joseph and I own a good amount of the same companies, and a lot of the companies that he puts on his watch list or he recently adds are companies that I brought up on Power Fives of like, hey, I would also like to own this stock, but again, I don't want to have 15, 20, 25 shares just or companies because I just don't want to spread myself that thin. So like when my portfolio gets up to 100,000, like maybe it's time to graduate to another position and start building that one or whatever. But like that's the only reason I don't own some of the stocks I talk about. Like I would love to own Broadcom. I would love to own Lowe's, Intuit, stuff like that. I would love to own them. But I don't want to, that puts me up to 16 holdings and I'm spread too thin. Instead of me putting $4 a day into Apple, now I'm putting $1.50 a day into Apple because I have to build up these other positions. So like that's really what it is. So like one of the questions, it's not the next question, but like one of the questions for you is like what criteria do you use? How did you develop that criteria? How do you stick to your criteria? And how has it been successful for you?
So I don't have like a set amount of rules. But one of the things like I mentioned before, dividend yield. I look for warning signs now, and that's just due from experience. Just because it's 5% doesn't mean I don't invest, and just because it's less than 2% doesn't mean I don't invest. I have to also look at the metrics, the growth rate. I think that's important. Like you were saying, 5 years. One of the things I honestly do starting is looking at aristocrats and kings. Now, I don't necessarily just have to buy into those because they are aristocrat and kings, but if you've been given a dividend longer than I've been alive, okay. I mean, that's a check. That's a jelly bean on that side. Okay. And then we're going to start adding more jelly beans to this counter over here. And and I start looking at things like that, and they don't necessarily, I don't have maybe a certain set of rules, but I'm looking for price to earning ratio, what their cash flow is, how the market is now. Like, let's use Starbucks. I'm invested in Starbucks, not a whole bunch, but at that time when I was invested, they hit what I needed. But like you said, right now they're not. So do I still have them? Yeah. But like you said, it's kind of just dormant. It's the little redheaded stepchild over here. We're just going to let it stay, but nobody's stopping buying coffee. There's still a Starbucks in every corner. My wife's probably drinking Starbucks right now somewhere, and it's like, that's how it is, but at the time it hit what I needed it to hit. I've been interested in REITs and stuff, and that's a whole different ball game. You're looking at a different type of aspect for those types of things, but just in reality, looking for a company that has a history of growth, a company that I believe and I understand how they make money. I think that's very important. The dividend payout ratio, like the yield and stuff like that, I is not as important to me, but it is important. I don't want to put all my money into things that are only going to give me 0.2% growth rate. That defeats the whole entire purpose. But then at the same time, I like to take control and not put everything into like ETFs and stuff. Like I do have a couple, but I want to take responsibility for my stuff and know that I won, not the guy that's getting paid to go rebalance, SCHD every year. And it's like you said, like, I'd love to have Broadcom. I don't want to spend $1,000 on a stock, like I would love to own Berkshire, but I don't want to spend a house to own one share so I can go to your meeting next year. Like, woo, like that doesn't do it for me. But there's other options and there are other ways of doing things. But I think for me, it's just looking at specific companies that I believe in, that have a history, that have the potential of further growth. And like you said, I think the biggest thing is just for me, growth over time, 5 years, 10 years, just looking at that. But I honestly am going to take a piece of your advice and look at something that's beating the market. Like what's the point of buying into something if it's not beating the market?
Well, I mean, that's why we do the individual stock thing, right? Is because we want to try to like at the end of the day, if I didn't have a YouTube channel with my Roth IRA, all ETFs except for Tesla. I have 6 ETFs and Tesla because I think, like you said, I like Tesla as a company. I will own a Tesla as my next car whenever my Subaru blows up, which will be a while. Side note, my battery did die the other day, so that's fun. I have a car appointment tomorrow, so that'll be fun for me. But like so Tesla's in there, but then like I have this YouTube channel. How boring would it be if I just did my monthly recap? Like, oh yeah, this month I bought 3.06 shares of VOO, and Didn't make any money because it only pays me in March, June, September, and December. But check back next month so I can tell you the same thing. Like, that's not fun. So like I wanted to like have something else, but I also have a goal. It's like, hey, my goal is not just to have these stocks for funsies. Like, I want to beat the market. This month I didn't do great. Like I had, I think, a 0.46% return versus the S&P had like a 1.6 or something like that. So, but like the battle's not won in the first quarter. We have to like let it play out throughout the year. We'll see what happens. And everybody knows the S&P recently is being carried by the Magnificent Seven anyway. I don't own all of the Magnificent Seven. I own Apple and Microsoft, but like the rest of my stuff is not Magnificent Seven stuff. So like, that's the rest. But so yeah, it's just one of those things. But yeah, so definitely if you don't already watch them, the Power 5 that comes out every Friday at 8:00 Central Time. So an hour, 30 minutes before the market opens, the Power 5 comes out. The 5 stands for like 5 categories that people that are in dividend investing care about. So the 5 are dividend yield, the dividend streak, so how long they've been paying and growing, the dividend growth rates, the 10-year return, and the last category is the stock that's the highest percentage off of its 52-week high, because that shows you that it clearly can hit a high. Right now it's down 20% or whatever, but it eventually might go back up there. So that's an opportunity for some gains. All of those stocks will have a dividend streak of at least 5 years, and they've all outperformed the market over the past 10. So like the idea behind that is not, hey, buy all 5 of these stocks or however many there are. The idea is if you're a yield investor, here's a yield stock that is higher. It's the highest yield of the week, because all these stocks, like where I get the list from, is they're all stocks that have X dividend dates next week. So therefore, if you end up deciding, hey, it's Friday, I'm going to watch this video. Oh, I do like this stock. I did my research on it. I'm going to buy some of this, and it's going to go X dividend next week. So you're going to get a dividend sooner rather than later. But like, only reason, it's not for the dividend capture strategy. That's not why I did it. The only reason I did it was because I needed a new list every week. And where do you get a new list in dividend stocks every week? The X dividend stocks. So, but yeah, watch that series. It's like the videos are anywhere between like 3 and 6 minutes every week. Super quick watch. And like, you can go on there and like, if you want a stock that's a little bit higher in yield than the first stock I talk about will be that, and just start looking at that. Like, you already know it's going to have a dividend streak. You already know it's going to have a outperformance of the market. And then you start adding your filters into it. What do you care about? Check it and see if it works. If it doesn't, move on with your day. Like, wait for next week's and see if that one does something for you. So yeah, that's the whole reason I did that series. One, it's good content for me to get out. I can do it every week. But also it's just like, hey, here's a list of, up to 5 stocks that they're the best stock in whatever category it's the best stock in. It has this baseline of standards that I hold it to, which are the ones I already mentioned. And if you like that stock, do it. If you don't, I don't care. It's not my money. Like, spend your money however you want to. So a little plug for myself there. But yeah, just check that out. And the one came out yesterday.
I'd be interested to hear, because you mentioned it earlier about like what's the trend at the time, SCHD, like 2021 or whatever it is. I'd like to maybe you could be the one to do it, but do a video on where they are now, like all these hot topics, because as a content creator, I can only imagine, I've thought about getting a YouTube, and I think everybody does, but it's like when you've got, I probably have a Magnificent 7 of my YouTube creators that I like to follow. You're one of them, the dividend growth investing. There's Dividendonology. There's a couple of people that I go to these people and I trust them. Not saying that I'm going to just go off of everything they say, but when they've done their due diligence, they got way more time, and they're making an income off of this. They're monetized and stuff. So they have some skin in the game, but it's funny, but when you say that, it's like, as a content creator, man, I mean, that's got to be able to come up with original content like that on a weekly basis. That's phenomenal, because it's like, I get tired of looking at all 7 of you go, hey, SCHD this week. Well, cool. Like, which video do I watch? Who do I give the viewing hours to? Because we're all talking about the same thing. And it's like, it gets kind of tiresome, at points, even just being on Twitter. It's like, we're all talking about this one thing today. We're all talking about this, and it's just like, to be original nowadays, it's very, very hard. So it's admirable what you're doing.
Yeah, I appreciate that. It's one of those things where I was like, the first question I asked myself is like, if I want to get 2 videos out a week, how can I make at least one of them a series that just keeps because the thing that stinks with like investing content for the most part, unless you're making like a guide to something video, my content's not evergreen. Like, next week when you watch, if you watched the video I just released yesterday, we're recording this on a Saturday.
Mhm.
So if you watch that one, like you watch that a month from now, it's not that it's useless, but a lot of the numbers are now different because it's, you know, it's changed.
Yeah.
Like it's the stock market. It changes every week. So like I can't make a lot of evergreen content. So I was trying to figure out, okay, how can I make content that's not necessarily evergreen, but like it's something that I can redo over and over and over again. And it's not just like, oh, every month I'm going to do a new video on SCHD. Like, cool. That great. You're really helpful with that. But like, it was like, okay, here's a fresh, and I was talking to, I think Mark was who I was talking to one of my interviews. And I was telling him, I was like, at first when I do, cause they got to figure a lot of these are quarterly paying stocks. So therefore next quarter at the same time, they're going to have a chance to be on the list again. And at first when I would do it and like Lowe's is on there for like 3 categories, I'm like, oh man, like Lowe's was on last week. And I'm like, or last quarters. And at first I was like, that's annoying. I'm not giving them new stocks. But then I was like, reframing how I think about that, Lowe's is good enough quarter after quarter after quarter to constantly lead in these categories. That's
Absolutely.
a good sign to me. Hey, every time I look at the best 10-year returns and Lowe's has the opportunity to be the number one, they are. That might be a good sign of like, hey, this is a good stock to look into because like they're always making you money kind of thing. So
there's a pattern here.
Yeah, I just reframed it where it's like, okay, yeah, it is annoying that I have to, you know, constantly go to Google and look up the same logos all the time. But like other than that, if these stocks are always on there, it's a good sign. Like if this stock is always, you know, have the best dividend growth rates every time it has the chance to be on there, it's always the highest dividend growth rates. That means they've clearly kept continuing to raise their dividend year over year over year at a really good pace enough to keep that record. So it's one of the, I don't know. Like I said, give it a watch. Anybody else that's watching that maybe hasn't given that series a watch. It's like, I'm trying not to do too much creative stuff with the thumbnail. That's really hard. That's one of the hardest parts about YouTube is like giving a thumbnail that's like catchy enough, but not cringeworthy enough. And you're just like, I'm not good. I hate it. So I'm probably going to keep the thumbnails the same where it's just like the Power 5 stocks of whatever week it is. They're going to change every week. So just give it a watch. Super quick watch. I try to put like some memes and stuff in there to keep it a little light and funny and stuff like that. But definitely a good thing. Like write them down, do your own research. Like that's where I said, like, it's good for you to have your own criteria to look at. You can literally be like, okay, here's this stock that Troy said, I like it. Doesn't meet that, cross that one off, go to the next one. Just that's literally the goal of it every week. And then if you, like I said,
if you too, the importance that to reiterate also something else is just because it doesn't hit all of your criteria doesn't mean it's bad.
Mm-hmm.
That's why we have the things called watch lists.
Yeah. And I literally said that in this last video.
18 different watch lists, like for certain things. And it's like, just because it's not there doesn't mean that I'm not interested in it. And it's funny because I'll look at something 6 months later and I'm like, man, I forgot all about that. It was on the watch list.
Yeah.
Like that's how extensive watch lists get,
you
know, and that's the thing. It's like, just add it to Troy's f.i.r.e, whatever, you know, whatever it's called. And it's just keep going and just that be a watch list. And then just, I mean, I think that's the thing. It's just people just need to realize like, there's just so much, man. I mean, you can't have it all. There's not enough money in the world to own all these things. You know, it's like, and to pick only specific ones that you think that are going to be home runs, it's impossible. So, I mean, it's just like you said, get your criteria out, find out if it hits. If it doesn't hit, put it over to the side and then start working on something else. And like with people like you that are coming out with fresh content every week, if you find something like a Lowe's and that keeps, oh God, man, he said Lowe's 5 times. Well, maybe that's the stock that you buy then. That's your first one.
You're sitting there looking for a sign and here it is.
Yeah, like here it is. I mean, he hasn't brought up anything else other than Lowe's. Like, okay, he's not doing it just because he's trying to get clickbait. There's a reason.
I'm not sponsored by Lowe's. Like they're not sending me a check for mentioning their stock. Like I'm not. So it's definitely one of those things. Like you said, definitely the watch list is good. And I think I said like something almost exactly like that in this last video where it was just like, I'm not saying all these stocks are the best stocks of all time or even that they're good buys at this current moment. But that doesn't mean that like you said, maybe it meets every criteria you want, but it's a little expensive for your taste right now. Cool. Add it to the watch list. Set your little targets of like, hey, if this stock falls between $82 and $90, I'm going to look to add to it. Or I'm going to look to start a position or whatever. Like that's the point of the series. So
that's the same process I use with I could use Cat for Caterpillar, for example. I'd love to own Cat. I just feel like it's too expensive.
Yeah.
Like I get it. Like it's a good company, but it's got to hit. I've seen certain levels where I don't want to buy in now. I've seen it happen. If you look at the history and you zoom out, they always say zoom out, and you can see more. well, it's hitting these certain levels. It may not be this year, it could be 2 years from now, but I'm getting CAD at a specific price. And
Mhm.
if I don't, there's a million other companies I could look at,
Yeah.
but that's always on the watch list, and there's always going to be a little bell at a specific amount, and I don't feel comfortable buying until then.
Yeah.
Doesn't mean it's a bad company. It's just I'm not a millionaire, man.
Yeah.
Make
Not
making
yet.
$5,000 a year. What are we
Not
gonna
yet.
do?
Yeah.
Yeah, exactly. So
Okay. So speaking of being a millionaire, so what are some of your short-term goals with your dividend portfolio? So let's just say short terms like in 2024. We just hit 2020. Yeah, 2024. So like what are some short-term goals you have with your dividend stocks? And then like what are some of your long-term? Like do you hope to like one day live off of your dividend portfolio? Some people just want it to be like the account that they can use to pay for their vacations. Like that's their whole goal for their portfolio. So like what are yours?
short term, I think, and it's definitely going to happen here shortly, is getting to $50 a month. I'm
Mhm.
at I average about 46, almost 47. Um, I would also say not like a short term in 2024. I don't think it's going to happen, but is eventually getting that up to 100
Mhm.
to get $1,200 a year. I started really late. Like I said, I'm 36 years old. I didn't know what a 401k was. I didn't have a big boy job up until 2015. That's when I got my first job that paid PTO. I was always a server, a bartender. So we didn't have days off. I didn't have any of that stuff. So I had no idea about this stuff. So I started really late. So for me, it's just to pay. Let's bring Verizon back in. Even though I don't own them, my original goal was to have enough Verizon that Verizon pays for my FiOS bill.
Mhm.
Um, so Verizon ain't cutting it for me, but maybe I buy into something else, like buy into a different company, but I can pay my FiOS bill. I can
Yep.
pay my electric bill. I don't have to necessarily buy into Dominion because that's who we have here in Virginia, but um, SO, I think that's a better company than Dominion. My wife has that in her portfolio because I've learned a lesson because I'm bag holding Dominion,
Mhm.
It doesn't necessarily have to be the same company, but I definitely wanted to be able to pay utilities and stuff like that when I get older, just to supplement the income because I started so late. I don't ever think I'll be able to retire and live like some of the people on there, the fire.
Yeah.
I don't think that's ever going to be it for me. If I do hit the lottery, I'll let you know,
Yeah.
and I will for
Yeah.
sure. But being realistic, it's just to supplement some of that income for make up some of the mistakes, as a kid that bad bad choices I made. I feel like I'm more responsible now to have learned from those lessons. Although I don't believe there's many second chances. It feels like, but the only person that can change that is you.
Yeah.
And so if I take the initiative now, it's like a, a conversation I had with my boss the other day about working overtime. It's more beneficial for me to work overtime doing my side job than it is to stay in that building for 18 hours a day.
Mhm.
And he's like, well, I thought you wanted the overtime. I do. And he's like, well, you're not working this weekend. Just because I'm not physically washing a house this weekend doesn't mean that I'm not going to make money 2 weeks from now or something. What you put in today matters in the long term.
Mhm.
So whatever work I'm doing today, whether it be my job, dividends, investing, my relationship, anything, whatever you put in today will pay tenfold in the long run. So I
Yeah.
think that's where it is for me, is just supplementing that income because I started so late.
Yeah. I mean, it's never a bad thing to like, okay, like my goal is to retire the wife and I off of our dividend portfolio. We're going to make
Yep.
110% of our expenses. We're going to live off of the dividends. Um, Worst case scenario, say that doesn't happen, but we're only making an extra $20,000 a year in dividend income. Woe is me. Like that's like a part-time job that I don't have to work. Like that's a good fallback
Yes.
plan. So it's
Yeah.
one of those things where I'm, shooting for the stars. This is what we're hoping for. And that's all by 50. Like maybe that doesn't
That's
work.
awesome.
And
How
I
old are
don't
you?
want to stop at 50. Do what?
How old are you?
I just turned 29.
Okay. That's awesome.
So
Yeah. Hell yeah, man.
yeah. I like last year was I think just over $900 in dividends. The year before was like 354. So like obviously again, like I just told you,
It's
I
happening.
practice what I
Yeah.
preach. I'm not focused on the dollars, like $900 a year. Like oh, who cares? Like that's not a lot. But like one, that is a lot, especially when it's passive. And two, that's up from three and a half. So like the
Right.
percentage growth, that's almost a tripling of my portfolio or
Yeah.
my income. So I'm not expecting to triple that this year to get 2,700. But if I can get the 1,500,
Yep.
1,600, like that's still a big percentage. So I'm still probably going to focus on the percentage, but also that's $1,500 a year that I didn't have. So
Right, exactly.
yeah, it's just one of those things where it's just, you have to reframe your mindset. And like you're saying, so one thing I'm going to like I said, I have a 1-year-old. One of the things that I really want to teach him, because I don't think that people, I don't want to say like Americans or Oklahomans or whatever, I don't think people have this skill, is understanding and valuing delayed gratification.
Yeah.
Everything's instant gratification right now. And dividend investing, me and my powerlifting, like it's going to be, I was just having this conversation last night. We went to the Thunder game. We were eating at one of the restaurants right by the arena. And I was telling my son's goddad, I was telling him, I was like, yeah, he said that when he was growing, when he had his kids and they were young, he would take them to the grocery store, and kids always want something. And he goes, versus telling them no, 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 he would just bring them a lollipop from home or whatever, and then they wouldn't want anything. It was a way better experience or whatever. And I was like, I like that idea. One thing I want to do that's probably a little bit different and may or may not be better is I want to teach my kid, hey, we're not going to act a fool in the grocery store. If you're good, when we get to the car, you can have X, Y, Z. And it's going to be one of those things like, okay, if I do this thing now, if I sacrifice now and behave myself, I get this reward later. And I think that's something that, like, as a society, we don't have. Everything, like you talked about with like GameStop and AMC and all these things. The reason that people, and Dogecoin and Bitcoin, everybody gets into that stuff. Why? Instantly get money. You get money quick. That's the draw to all that stuff. I can take $100 and buy however many Shibu Inus or whatever, and then it goes up a quarter of a penny, and now I'm rich. Like, that's what they want. They just want that quick money. Nobody gets into dividend investing to get rich tomorrow. That's not what you do.
Right.
So like I buy this stuff today, knowing that 20 something years from now, there's my delayed gratification. Was it worth it? Well, I'm 50 years old. I'm retired. I do whatever I want, and I have more money than I know what to do with. I think it was worth it.
Yeah,
so,
absolutely.
Yeah, I don't know. That's a little tangent on like just one thing that I'm trying to like. I try to learn that with myself is like, okay, like there's not always going to be a reward today. Like you with talking to your boss, like, yeah, the reward today isn't that you have a job to do your power washing with, and you're going to get paid today, but you're planting the seeds to get paid tomorrow. That's delayed gratification, and people like even your boss doesn't understand that.
Yeah, it's like that's trying to say, like one of my coworkers, he understands because we always talk, and it's like. They think of it as a hobby, and it's like I get it because I'm not making a W-2 per se, but it's like if I'm not like as soon as I get off of here, guess what I'm doing? Putting my pants on, I'm going out and putting out yard signs. I'm not getting paid to put out those yard signs, but somebody's going to see that yard sign 3 weeks from now and give me a call, and all of a sudden I make $350 washing a house. Okay, so. But then somebody else is going to see that sign. 2, 3, 4 people are going to see that sign. Now that sign is now worth $2,000.
Yeah.
And it's like all because of the work I put in today.
Yep.
And it's like I just like you said, man, instant gratifications, the shorts, it's the reels, all these things, Instagram, all that stuff. That's great what you're doing. I've been following your channel for a while, and I've heard that he had him a credit card from the moment he was born.
He's got
man.
He has a year worth of credit card history already, man.
Dude, I've told my wife about that. I'm like, I can't wait until that kid is 18. Like, I look forward. I hope that our relationship continues because it's like, man, that kid's gonna be richer than me. Like,
hey,
he's gonna be retired.
Yeah, my goal is he's gonna
working.
retire before I do. Like, it's gonna be one of the. I'm like, dude, what the
That's-
heck? Like, how did I have a?
That's fantastic. I mean, because that's the thing. I wish I was told, oh, the stock market is a rich man's game. You got to have at least $10,000 to start. Man, I was making in a restaurant. Oh, $100 a night was a great night. Like, when am I going to get $10,000 to start this? Like, and I think that's the fear that the rich man or whatever you want to call it said that instilled into me. Like when I first heard about stocks, that I blew it off. There's no way I'll ever have $10,000 in a savings account. You're out of your mind.
Yeah.
You look at my portfolio now, and that's one thing that I try to do. I battle with mental health, and it's like one thing I look at is like, man, look at where you were 5 years ago.
Yep.
And it's like snowball. You didn't have any money to your name, and now you've got $40,000 spread between 4 different accounts. But that's $40,000. You didn't think you were ever going to have $10,000.
Yeah.
Plus, I also have a savings account. I have checking account. I have all this other stuff, and it's like, look at where you are. Look at the snowball effect. That's it happens in life.
Yep.
And I think what you're doing for your son, man, that's fantastic. And envious that he's going to retire before me. You know, that's great. But it's something that I just wish more people would do, man, because it's like, you know, and then and I think the importance of spreading the word about fractional shares.
Mhm.
You know, I said that on a podcast with Dave a while ago when I was on that one. I think fractional shares, man, if that was around when I was young and I was 18, oh boy.
Yeah.
Like, even if I did make mistakes and did all the same exact mistakes I did now, but I was able to put in $20 a week into Apple. Like, I look at, let's use Microsoft for example. I got my first big boy job in 2015 working in a machine shop. I look at Apple September 1st when I started. That thing was $45.
Now it's like what, 190?
Microsoft?
You said Apple.
Oh, I meant Microsoft.
Okay,
I'm
okay,
sorry.
okay.
Yeah, so Microsoft was $45.
Yeah.
Now it's like a $400 stock.
Yeah.
And they pay dividends, you know, and it's like all that just could have put in, you know, a couple of, but you got your first big boy job. But no, I wanted to go to every concert. I wanted to go to WrestleMania. I wanted to go, you know, travel and do all this other stuff. Like, yeah, I had fun, but ask me right now how many concerts I saw and which one was the best one. I don't know, dude.
They were
I
all
don't know, but
loud, like
yeah, they were all loud. I'm getting old, you know. Gary Clark Jr. is my favorite, so I remember that one. But it's like, and I do remember WrestleMania. That was a boyhood dream to go to that. You know, I was an adult watching grown men in their underwear, but it's just something I had to do, man. I had to be there, you know. And it was like, so there's a couple of things I don't regret, but it's like, yeah, did I have to go to every concert that came into the town? Did I have to? No. I should have picked the ones I chose, you know, because what I do remember is the fact that Microsoft is $45 and it's not anymore.
Mhm.
You know, like, cool. I got to see Rob Zombie. That's awesome. I've seen him like 2 or 3 times. Like, once is enough. Like, did
Yeah.
I have to go the other 2 times? I could have used that $45 that I bought on that ticket to buy Microsoft, and that
Yeah.
would be now worth 400 and whatever dollars
Yeah.
today. You
Yeah,
know?
it's and that like that's I have a lot of conversations with people like that where it's just like, oh, I don't want to invest now because I want to live my life or whatever. Like, and it's what happens is you end up pushing,
Mhm.
kicking the can down the road. Oh, I'll invest for retirement later, like when I'm in my 30s or my 40s or my 50s. And then when you, so I have a video series slash some shorts, tongue twister, that I'm working on, where basically it's the idea of like, obviously it's better to start when you're younger. So the idea
Mhm.
behind the video is like, okay, well, if I wanted to be a millionaire by the time I retire, which I think it's widely considered that retirement age is 67, like full retirement age 67, which is a long time.
And they want to raise it.
Yeah, exactly. It'll be 75 by the time I'm there. But so they classically consider that. So I was like, if you wanted to have $1 million, which obviously everybody knows, $1 million when I'm 75 won't be worth $1 million today. Like we all know that,
Mhm.
but it's still $1 million. Like what it can buy is different, but it's still $1 million. So like it still has the same number of commas in it, regardless of what it can buy.
Mhm.
So if you wanted to have $1 million when you turn full retirement age of 67 and you started at 0, getting an 8% return, how much would you have to invest per month? And like nobody knows the answer to that. Like I
Yeah.
ran all the numbers. I literally did the numbers from 0 to 67, how much you would have to invest per month to get to $1 million by the time you're 67. Well, technically 0 to 66 because you're 67 already. So, but like, so 0 to 66, how much you would have to invest at 8, 10, and 12% returns. And it's just per month from that month until you turn 67. And it was, so spoiler alert, if you were 0 and you got a 12% return, you need to invest $6 a month until you're 67 years old and you'll be a millionaire. That's it. $6
Jeez.
a month. And that,
Wow.
so I think when I did the calculations, that was like it was like 2,844 or 4,844 or something like that. Like I know there's a bunch of 8s and 4s in there, but like just say it's $5,000. 5,000 of that $1 million is your own money. The rest of it, capital appreciation.
Wow.
Isn't that wild?
Yeah.
$995,000 of capital appreciation.
Dude. I mean, it's the thing is like, I don't, and it's so funny, man. You bring that up because it's like people don't look at things like that. They're like, oh, you know, I'll wait. One of the things, life insurance, anything like that, like when you start young, if you were to get it at 16 years old, it'd be like $5 a week.
Mhm.
Like, I ain't gonna spend $5 a week. Well, then you start to have a family in your 20s and your 30s, and now you got to pay for the whole family, and now it's $45. well, I don't have the $45 because I'm living paycheck to paycheck and da 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 da.
Yeah. I'm healthy. I
And
don't
it's
need it.
like,
I'll wait till I'm older.
yeah.
Yeah. Yeah.
And it's like, and you start looking at it, it's like these people don't design this for any other reason but compounding interest. And they know exactly what it is.
Yeah.
Like if you start early, this is what it is. That's why there's a cap on the 401k every year.
Yep.
You know, I mean, if it wasn't as good as they say it is, they wouldn't tell you 6,500 is the max or 7,000. I guess it is this year. It's like they they let you do whatever you want, but
Mhm.
they know the effects of it.
Yep.
If you don't pay taxes in the long run, we got to put a cap on this now because somebody's going to be smart enough to put all their money into this,
Yeah.
and then it defeats the whole entire purpose for them. And it's like the house always wins if you don't play the rules the correct
Yeah.
way.
Yeah. Same thing with like
And
credit cards and stuff is like people,
yep.
I own Visa as one of my companies. I
Mhm.
have Visa credit cards and Visa doesn't make any money off of me. My cards have no annual
Yeah.
membership or anything like that. I pay my card.
Mhm.
Literally, I'm in Fidelity
I pay it every day.
every day I'm in Fidelity. So like I use my card on gas every week. I was using it on groceries, but my grocery store stopped accepting credit cards. They only accept debit cards, so that's annoying. But so gas and then like any other expenses that I have that I
Mhm.
can put on the card with no fees, I do that. And then every time I'm in Fidelity every day, I'm like, oh, there's a balance on it. Just pay it off. I don't even know what my cards do because I just pay it every day. And so therefore I get 2% cash back from Fidelity's credit card. I get no fees from Visa for having their card because I don't pay interest on $0 and there's also no annual fees. But yet
Mhm.
Visa continues to outperform the market. They continue to make more and more money. Who are they making that money off of? The people that
Fools.
don't pay their credit cards that are paying 24% interest on cash that they didn't
Yep.
have. So it's
And that's
just
the
one
thing,
of those
people
things.
and people don't look at they'll sign up for a credit card because it's like, oh, you get $300 if you spend X amount of dollars
Yeah.
here
But you're
or
spending
whatever.
money you weren't going to spend.
Right.
Th-
And then
That's
you don't look at what the interest rate is and
Yep.
understand what a variable interest
Yep.
rate is. That means if they're having a bad day, they're going to charge you 27%.
Yeah.
If they're having a good day, they'll charge you 17.
Yeah.
But it's how the market is going, and you don't understand the market
Yeah.
because you're just a normal person that lives off of credit card debt. You're not investing because you spent all your money on a credit card. You have no idea what it takes for a variable rate to be variable,
Yep.
and you end up, oh, let's buy furniture from whatever rooms to go. No, no payments till 2020, 30 or whatever, whatever it is, 5, 10 years from now. But the moment you don't pay that whole entire thing off, that little contract you signed says that you owe 33% interest from day one,
Mm-hmm.
from when you first got that
Yeah. It's
sweet couch that
retroactive.
isn't
Yep.
yeah, like the couch that's not in your house anymore because it's made out of nothing,
Yeah.
that you're still paying on. Now you got to pay 33% interest on something you don't even own.
Yep.
And I think that's a huge problem. I mean, I'm the same way as you, man. Every day I go on. That's the first thing I do when I get home. Pay the credit card bill.
Yep.
Pay the credit card bill. We spoke off camera about how much was on that credit card when I was in the fire department, and it's like, no, that's never going to happen again. You're
Yeah.
not catching me with
Yeah.
10. I mean, my interest rate is low. I have a 10% credit card. That's phenomenal
Yeah.
for most people, but it's still 10%.
Yeah. I
Like
mean,
I
that's
get,
the historic return of the S&P is like 8 to 10%. So like you're not even going to beat that. Like you're losing
no,
more in interest than you're going to make in the stock market.
yep,
Yeah. So
yeah,
I mean, the
it's
best way to do that's not to have any balance on it. So I don't even know how we got on the credit card thing, but it's just one of those things where it's just I don't know. So going back to that $6 a month, like that's obviously $6 a month from 0 to 67 is a lot of months worth of paying. But that's still only, like I said, just say I have the actual numbers, but I don't remember them. So
Mhm.
say that's $5,000 that you have to spend on that, which is great. But if you started at like 18, like say that's, $46 a month. And like
Yeah.
it just shows you that's an extra $40 that you have to spend every month from 18 to 67 just to get the same amount of money.
Yep.
And it just
Yep.
shows you. And like I said, I want to do shorts probably on like each individual age and how much it would cost. And
Yeah.
then I'm probably going to do one for like, hey, if you have a kid between 0 and 12, this video is for you. And then like I'll just explain, like I'll give them
Yep.
the chart and show them all the numbers and stuff like that. And same thing. Or if you have a kid that's a teenager, or are you a teenager? Here's this video for you. Just to like, because I'm really like at the end of the day, it doesn't matter to me whether you become a millionaire or not. At the end of the day, I hope you do because you're a nice guy. But I sleep the same regardless. Same thing with all the people that do or don't watch my content. If they want to, if you have a kid and you have a brand new kid and whatever, the last thing you're thinking of is adding $6 a month to an investing account for them. but should it be the last thing you're thinking of?
Right.
Because like you can take care of that. And like, okay, little Johnny turns 18 years old. You're like, hey, little Johnny, I'm not going to put this $6 a month, but here's what I've been doing since you've been 18 or since you were born. I've been putting this in here. If you keep this up, you're going to be a millionaire by the time you're 67. And obviously, if you want to put $7 in there, go wild. You'll have even more money.
Yeah.
But like, you don't need to do $6. That's literally less than any subscription you're going to pay for.
Absolutely.
And it's just like wild to me. And like, that's what, going back to what we were talking about before, that's what people don't get. Is like, oh, I'll wait till later. Okay, well, when you're 45 and you want to get to $1 million, you might have to put $1,300 a month back from now until you're 67 in order to get that same $1 million that little Johnny did for $6.
Yeah.
Like, is that worth it? Like that, to me, that's crazy.
Yeah. I mean, you have to think about the amount of like, this is like you're saying, like at 18 years old, you got to pay $45. Well, that's 2 hours of work.
Yeah.
Just to go to that.
And that's
now.
forever. That's until 67.
Forever.
Yeah. For 60. So for the next 40 years or whatever.
Your bills. That's not including food,
Yep.
not anything else. It's just to supplement your income because you decided to make dumb choice. You know, I mean, it's like, yeah, you're absolutely right, man.
I mean, honestly, like if somebody told me right now that if I gave them $45 a month, I'd be a millionaire, like I would do that. Like that's still good.
Yeah.
But like there does come a point where like it was crazy as I was doing that research, I started to get like obviously later in life you need to add more, but like it was going up by a lot per month.
Yeah.
Like it was like, oh, okay, you need, I don't remember the numbers. They say it's $5,000 a month at 50 in order to retire a millionaire by 67. But then it was like at 51, you need like $6,200 a month. I was like, that's wild. I was like, that's literally just 12 months different. But because you're not getting that extra year of compound interest, you have to pay that much extra. And it's per month, every month, no skipping, every month from now to 67. I'm like, that's wild.
Yeah.
And then it was just really depressing when you were like in your 60s.
Yeah. Oh, dude.
Yeah. I was like, I don't even want to do these numbers because if you start, it's like, yeah, it would, I don't know. I finished it, but
it's one of those, man. It bugs me because I'll look at people like, I'm becoming a softie as I get older. And it's like, I'll look at these elderly people working and I'm like, really? Like,
yeah, I always wonder
it
if
brings
like,
a tear to my eye and I'm like, man, I don't want that to be me. I know I messed up. I know I made some mistakes when I was younger, man. I'm doing everything I possibly can to change that. I'm a better man than I was yesterday. To post it on my door. Better man than be better than you were yesterday.
Yep.
And I look at these people and I'm like, what did they do?
Yep.
That made them have to work at Walmart on the graveyard shift. Like what? For minimum wage? Like, oh my goodness.
That's I always wonder that stuff. Like there was a guy when I was working in office. I remember his name, but I won't say it just in case he watches. But he was, I don't know, as nice as I can say this, he didn't look a day under 65. So he was older. And I just wonder, I'm like, at a certain point, are you actually, now that I'm remembering him, I would be surprised if he was under 70. Like this dude he was up there. Like didn't move. Like you always wanted to make sure you got in front of him if you had to go somewhere, because it would be a while if you were behind him. But, and I always wonder stuff like that. Like some of these people work just because like, hey, I don't want to be, I don't want to be at home all day. I don't want to be bored, whatever. Like that's a different situation. Like I get that. But like in most cases, I'd be willing to bet that a lot of these people work because they have to. And I don't want to be in that position. I want to be work optional from 50 on. If I want to work and I'm like, hey, I know as a personal trainer, I'm not going to make a lot of money. The hours suck, whatever. I'm like, hey, I'm going to do Wednesday and Thursday from 10 to 2. I'm going to be a personal trainer. I don't care what I make. I don't need this money anyway. I just want to help people be in shape. I want to get people in shape, give them the right knowledge, stuff like that. I want to be able to do that. So yeah, it's just, I agree with you. When I go to like Walmart or something like that, and I see people that are working there because they have to, and they're that late in life, they can barely get themselves around, much less, work a minimum wage job because they, like you said, because they have to. It's disturbing, one, for them. And then obviously you like looking in the mirror, you're like, hey, I need to get my stuff in order because I don't want that to be me. So, okay. So you talked about one of your milestones being $1 a day in dividends and how you are past that now. You said you're getting close to $5 a day, right?
So I should be $50 a month here shortly. I'm at 47, just roughly.
Okay, yeah. So the question is, what role does having like little milestones and achievements like that, like what role does that play in keeping you motivated to like keep going? Because like we said, dividend investing is largely delayed gratification. So like what role does that play in keeping you motivated to stay on this dividend path?
I just want to make sure you can hear me because I have one of my
Yeah.
earbuds.
Yep. I hear you. Yep.
You're good? Okay. Um, for me, I mean, I like to look at goals. I like to break down goals into micro goals.
Yep. Yep.
That's a thing. A lot of people don't look at. They look at a goal and, hey, if I don't make it here, you know, they get deterred and they start moving off from that. So I like to break down any goal I have. Like my ultimate goal is to obviously have more than $50 a month, but you pick a number and then we start breaking it down.
Mhm.
And so for me, that's the only way I can succeed is if I do micro goals. I have to have a win every single day. Or I feel, like I said, I just feel off track. So whether it be, I have X amount of money I need to make in this swing trade, I need to make a certain percentage on a swing trade. I take that money and I'm using that towards my micro goal. I take any money that I make from that and I move it over to this account, and then I can start doing it in my dividend portfolio and start building that up and up and up. For me, goals are very, very important. If you don't have goals, just like a stop loss, if you don't have an entry and an exit strategy, what are you doing?
Mhm.
So just to have the money in the account is not the goal. The goal is to supplement, like you said, maybe you want to be a trainer. I don't think I'll ever live off the money, but my goal is to have a job that I don't go to work every day hating.
Mhm. Yep.
And if that entails that I can take a huge pay cut and go do something that I like because I have my utility bill paid, my Verizon bill paid, and my water bill paid. Well, cool. Now I can take an even bigger pay cut and do something even more that I like, and it's finding those little things, the steps on the yellow brick road, man. And
Mhm.
that's for me, that's what it is each micro goal is just another brick that I add on, you know?
I give the analogy all the time, and I think this is like the best way to say it is my ultimate goal, like I said, is to retire and live off the dividends. That's the top of the ladder. A ladder is really useless without the steps on the way.
You ain't
Like if
lying.
you have a 6 foot ladder
It's a
and it's
steps
just like
tool.
the bottom and the top, like you can't climb that ladder. It's impossible.
Yep.
So like if my only goal was I don't care what I'm making this month, I don't care what I made in 2023, I want to retire off of dividends. Maybe I'll get there, maybe I won't. Odds are I won't because I don't have anything to like, oh, give me that reassurance I'm on the right path. But like if you have a 6 foot ladder, I don't know how often a step is, like what every 12 inches there's a
Yeah.
step.
Yep.
So like you have every 12 inches there's a step. Why is that? Because that makes it useful. It makes it more obtainable to get to the top step because you have little steps in between. So it's the same way in dividend investing. Like you have to have
Yep.
those steps, whether it's because like the cool thing, like many dividend investors, when you open up your spreadsheet, you have like what you're gonna like your patty, your projected annual dividend
Mhm.
income for the year. Then you divide it by 12 for the month, and then divide it by 365 for the day. And like there's always one of those numbers that's close to something else. So you're like, oh,
Yeah.
okay,
Yeah.
like I'm getting really close to $5 a day. Cool. When I hit that, ooh, I'm getting really close to however much a month. Ooh, I'm gonna try to hit that. Ooh, now I'm getting really close to this next milestone of $1,000 a year, and you just
Mhm.
shoot for that. By the time you hit that one, your day's probably getting a little closer to the next milestone, and you just
Absolutely.
keep shooting for that stuff. And it's, I agree with everything you just said. It's like so important to have the goals. That's why I think it's really like whether you're a spreadsheet nerd or not. Like I'm in data analytics, so I'm a nerd about spreadsheets. Whether you're into them or not, having some version of a simple spreadsheet that like track year over year growth. And here's what you made last January. Here's what you
Mhm.
made this January. Like it doesn't need to be pretty. Just put the numbers on there. And just like you can go on ChatGPT and you're like, hey, I have this number in here. I have this number in here. I'm trying to figure out how to give me a year over year growth rate. It'll give
Yeah.
you the formula. Paste it in there. You're done. Drag it down. You're good to go. Like it doesn't
Yeah.
need to be anything complicated. But the process, the reward you're going to get from such a simple thing, such as tracking your goals and keeping them and tracking and setting goals, is I think one of the most important things you can do in the game. So
Yeah. Especially like we mentioned numerous times in this podcast. I mean, everything is that instant gratification. But for me, my instant gratification is checking out my spreadsheet. Every time I get an alert on my phone and I type in the new amount that I made that month or, that week or whatever it is, that's my instant gratification.
yep,
It may not be those huge numbers, but it's like I can just scroll up and go, wow, man, I remember when I got Apple for 2 cents, man. Now look at it now.
yeah,
Or, you know, let's use O as an example. That I remember that first one. I mean, I bought one share and you made like I think it was like 21 cents or something when I was originally there. Now it's 26 cents a month, and you start looking at it and that thing just I can see the snowball effect on that
Yep.
specific one. And I'm like, oh man. And it just gets me so pumped because I'm like, I know that's a monthly dividend, but it's the same thing as if you break it down yearly. It's just these numbers. You can take any dividend you have and make it a monthly dividend if you
Yep.
really want to.
Yep.
It's just a matter of how you're looking at it. So it's just if that's how you have to do it to make your mind stay focused and keep those blinders on, then so be it, you know. But I mean, it's I talk about my wife multiple times. It's like she looks at it and she's like, "Man, I don't know what we're doing, and I have no idea." Like she doesn't even know the password to her account. Like
Yeah.
she's just like, "It's cool." She's like, "Cause eventually that thing's gonna grow and grow and grow." And she was like, and I remember when she got her first dividend, I think it was Starbucks, and it was like, boom, you got 3 cents. And she was like, finally they pay me. You know, she made a little joke.
Yeah.
And then now you look at it and it's like she's almost out of coffee, you
Yeah.
know, and it's like, heck yeah, man. Like you can buy she can buy at least they're probably like $10 a coffee. I don't drink that crap.
Yeah.
But she can get 2 coffees a year, you know,
Yeah.
like, but before it was like, you know, we're spending that money, you know, but at least even if she bought a coffee every day, well, now there's two less.
Yeah.
So I'm good with that,
Yeah.
you
Yeah.
know?
Reframing it's big. Like I said, when you first start dividend, me, anybody first starts dividend investing, it's the little bit you'll get. Our first dividend, like for me, it was quite literally a penny. I was
Yeah,
excited about that because one, I'm the type of dude when I go to the gym, if I see a penny in the parking lot, I'm picking it up, and then I count those at
me
the end of
too.
the year and see how much it is. But so that was cool, and it was free. I didn't do anything for it. But so when you tell somebody that's not into it, oh, if you invest that penny over the next 37 years, it might be worth 7 pennies. Like, okay, well, like that's a good joke. But like when you're still working and I'm not,
Mhm.
or when in your case, when they're still working and you have your mortgage or your rent paid for every month by your dividend portfolio, then they're like, oh, hey, how do you have extra money? Like, well, my dividend portfolio pays for my mortgage every month, so I don't have to worry
Yeah.
about that. And
I'll
you're
tell
just
you how much you need. Let me pull up Troy's video, and you
yeah,
now
yeah,
need
yeah, exactly. Well,
seven
see, look, if
thousand
you would have
dollars a
started
month
when
to
you were
get
making
where I'm
fun of
at,
me,
brother.
yeah, if you would have started when you
Exactly.
making fun of me, you only needed to invest $51. Well, now you need to invest
Yep.
$236. So,
Yep.
yeah. So, the next question. So, I don't even really know if you can answer this because your like goal's not to live off the portfolio, but like if you were giving the advice to somebody like me, who my goal is to live off the portfolio, what would be a good guesstimation of like when I could say enough is enough? Like I think in my mind, I want to get to 110% of expenses. My expenses are including how much I save per month and how much I invest per month. So in my head,
So
if
yeah,
I get
I've
to
I've I've heard you say that in
yeah,
a previous episode.
yeah.
That was like when you said that, I was like 110. That's pretty good. And then you were like, but that's what I invest. And I was like, good lord, dog. I was
Yeah.
like, my man
Well,
is
yeah,
right.
it's a lot, but like you gotta
It's
like
a
I
lot.
think right now our monthly expenses are 3,500. That's
Okay.
including what we save for the house. No, that's not included. So including what we're saving for the house, which obviously we're not going to save for a house forever because that's not a thing you buy all the time. But like including what we invest, I think we're at like 5,500. Let's just say. So if
Okay.
we can get to 110% of 5,500, which I don't know what that means. So let's just say $6,000,
Hmm.
just for numbers. $6,000. That would mean that our dividend portfolio is bringing in 6K a month, which is already enough to pay for our expenses, and it's enough to continue to invest the money that we did to get there in the first place.
Right.
So therefore, my
Uh,
portfolio that's already paying me enough is still going to continue to pay me more and more because I'm still adding to it. So that's my mindset is like, okay, that's when I'll know. Like that's kind of like over the course of these interviews, like Chad was my first one, and he's the one that came up with that the 110% thing of like including everything, including savings and investing. And I was like, that's a good
yeah.
thing because like
No,
it's
yeah.
you won at
I
that
I
point.
don't. I never thought of it that way until I actually heard you mention that, and it kind of got me thinking. Like, because you can't really, we don't know where inflation is going to be.
Yep.
We don't know what's going to happen. But I think ultimately, what it really comes down to is it's the same thing. I mean, are you what's going out? Is that still? Is there more coming in
Yeah.
or being gained over time than what's coming out? I think at that point you're fine. I
Yeah.
mean, and that also we don't know where life is. Are you going to be a personal trainer? Do you want to, what do you want to do? Because the thing is you retire at 50. I mean, you've still got an average of 20 to 30 more years
Yeah.
of life, roughly. Like, who knows what happens in that time frame?
Yep.
You know, I mean, like you said, does the $1 million really, is it $1 million? Then it's not. So is 110% good? It sounds good now, but I think you're already on the right track because we spoke about it multiple times. It's just rebalancing that,
Yeah.
looking at it every year, being like, is 110 good? Maybe 111 next year, or maybe 109. We don't know, but
Yeah.
as long as you're adjusting with the course of time, I
Yeah.
think you're light years ahead. I mean, it's just, and also like when it comes down to it, you're gonna have to. There's gonna be a point in time where you have to take the money out.
Yeah.
So as long as, like I said, as long as there's more money being gained, then what? I mean, that's all FU money at that point.
Yeah,
You know?
well, and at that point, like the reason that I'm doing a percentage and not like a dollar, because I hear a lot of people like, oh, once my portfolio is making me $50,000. Well, if that takes 20 years, 50K 20 years from now is not 50K today.
It's not.
So
Yes,
like that's why
absolutely.
I don't want to do a dollar amount. To me, the percentage
Right.
is more important because it's like, okay, my expenses. I mean, hopefully not too much, but my expenses are always going to keep up with inflation because it's what I'm actually spending. So
Hmm.
like as my expenses, like I might be spending $3,500 a month on like bills and stuff now, like between the wife and I, but say 20 years from now that's $5,500. Okay, cool. I still need 110%. Like it doesn't like obviously the numbers change, but 110% the goal is still good. And like you said, maybe a 10% buffer is not good enough. Maybe a 10% buffer is too much. I don't know, but like to me initially, and like once I get closer to that period, I'll start like actually running the numbers. But it's kind of pointless. Like I can run the numbers today, but 21 years worth of variables is too much.
Yeah.
Like,
Yeah.
okay, is the market going to give me 8% over the next 21 years or 15%? Who knows?
Yep.
So like, or is it going to, maybe I get 4% returns over the next 15 years or 20 years. Nobody knows. So it's one of those things where like, I take educated guesses right now and just set like kind of parameters. But again, we have those small goals to help us get there and stuff like that. So yeah, it's just one of those things that I always find interesting to hear people's responses. And like I said, it's a question more geared towards anybody that does want to get to the point where they want to live off of it. But for you, it sounds like you're just going to keep investing. And
Yep.
eventually, if you have to take money out of your dividend portfolio, whether it's to pay a bill or go on vacation or whatever it is, like that's what it's there for. Like you did your
Yep.
delayed gratification
It's
to
my
have that
fun
money
money,
later.
man. I think of it as the money that I worked hard for that nobody else can take away from me.
Yep.
I'm going to use it in a tax advantage account. I'm going to use it to every advantage I possibly can. And at that point, it's just all the trips that I didn't take, all the concerts that I'm missing in this process. Like, I mean, the Rolling Stones are still playing in their 80s. Like, to me, Gary Clark Jr. will be playing well into his 80s, I hope, or the bands that I like or
Yeah.
the shows that I want to see and stuff. There's always going to be a WrestleMania,
Hopefully the
something like
Rolling
that.
Stones still aren't playing when you're
Good
that.
Lord, yeah.
Yeah,
Hey, they could be though.
that'd be the Rolling
Who
Raisins
knows?
at that point. Yeah, that'd be
Yeah.
really rough.
Who knows at this point,
Yeah.
man?
Hey,
But
it'd be like like a holograms and stuff. Would you go see that?
yeah, I was gonna say, like, remember when Tupac came out
Yeah.
to Coachella? Like,
Yeah.
yeah, I mean, maybe I'll see him then. But
Yeah.
right now, I mean, I'm got the horse blinders on, man, just kind of trying to stay focused and
See? And then that'll eventually turn into the Apple Vision Pro instead of horse blinders. Then you can watch
see.
it from your living room. See? See
There
how
we
that
go.
works? Long live Apple. Okay. So next question, I'm really curious for your answer on this one. So like how important is staying diversified to you? And like what criteria do you set for yourself to make sure that you are or are not diversified if you don't care about it?
To me, diversification is important, but it's also like I don't have something in like I don't have two or three stocks in every sector.
Mm.
Like for me, healthcare, Johnson and Johnson. That's it.
Yep.
I don't feel I need to get into United Health and all these other ones. Like I originally, that's how the original portfolio was, but I had like 50, 60 stocks, and it just got to the point where it's like, let's just find one or two. My tech sector is a little heavy, just because I know that's where the world's going.
Mhm.
I don't see Apple and Microsoft going anywhere. I don't see Nvidia going anywhere, Tesla, these kind of things. Like, so I'm a little heavy in that section. But then I look at like my banking and stuff like that. Like I've got one bank, I've got one health, I got a couple of REITs, like, but find stuff that I like to tell people when they first start out, look around your room. I mean, right now there's Converse there's Adidas, there's certain things, Verizon. There's three things right there. There's three stocks. Those are the first ones that you need to look at. and then find out what you spend your money on. Start there, then start looking around. What else is everybody else spending their money on? When I go outside, everybody's got a Starbucks. Okay, well, that's a company to look at. It doesn't mean that you put all your money into it, but okay, let's find out. Like COVID happened, you and I both started then. Well, toilet paper didn't go anywhere.
Yeah.
Cleaning products didn't go anywhere. So to me, it's just natural to put money into Procter and Gamble. Like that it's also a king. I mean, it's like you look at these things and it's like now they're hitting different criterias just to sustain life in general and just the mishaps of life. When the housing market crashed in 2008, we were both too young to realize what that really meant.
Mm-hmm.
But it's like Procter and Gamble, people still needed to wipe their butt.
Yeah.
People still need, it's just there's certain things. So finding companies that I believe in and that I see that are going to be around for a long time, that's what I use my diversification for. It's not that I have to have 10% in this or, like let's use Walmart versus Target. I'm a Target shopper versus a Walmart. I just think the level of customer
Yeah.
is different.
Yeah.
So I don't think it will ever be Walmart. I don't think it'll ever be that top-notch number one company, but I see the potential growth of that long term. So that's where I put my money into that one versus a Walmart, but I don't put everything into that, all into Target or all into like half and half. Like to me, it was one or the other, because I know if Walmart goes up, Target may follow, or if Target goes up, Walmart may follow because they're in the same area,
Mm-hmm.
So for me, it's not a specific number or a specific amount of stocks I have to be in. It's just getting a little piece of everything, but just finding if I don't understand that sector, like financials, like I don't understand it, so I've only got one bank. I go with the bank that I know, and that's it. I don't know healthcare, so I go with Johnson and Johnson. There's so much Johnson and Johnson stuff in my house. Like there we go from that point on. But things I do understand, tech, yeah, I'm gonna have multiple things. More probably a little bit heavier diversification than that, but that's just for me personally.
Yeah. Yeah. I mean, you have the 11 sectors of the S&P 500. I own 9 of them. I don't own real estate because I own a house and it's also my taxable account. So I own real estate in my Roth IRA. I own VNQ, which is a real estate ETF. And I also don't own communication services because I don't like any of them. Like it's T-Mobile, AT&T, and Verizon. I'm not giant fans of any of them. So it's just one of those like you said, it's your personal portfolio, it's your personal finance. You can make it you can gear it exactly how you want. And now maybe if you come on, the Dividend Discussion podcast years down, not you, but anybody watching comes on the Dividend Discussion podcast years down the road, you're like, hey, one of my biggest mistakes was that I wasn't diversified or I was too diversified or whatever it was. And like you make your bed, you lay in it, and then like you give it time to marinate. Don't just, oh, I had a bad month. That was a bad strategy. I need to blow up my whole strategy and start something else. Like a month's not long enough, but
Right.
maybe a year's also not long enough. Maybe 10 years is too long. Like nobody knows what that sweet spot is. So it's just all about, being able to adapt, like we talked about a million times already. And I don't know. Like to me, diversification is, there's some of the smartest investors of all time are either super for it or super against it. Like I feel like it's one
Right.
of like the more polarizing like topics in investing is like diversification, which you wouldn't think like, okay, like don't put all your eggs in one basket, like seems to be pretty universal, but like Charlie Munger hated diversification.
Right. I mean, that's the thing. I mean, when you look at it, it's like, what if you know a sector?
Yeah.
I mean, and you were born and bred into tech or something like that. It's like, I get it. I totally understand. There's no reason for diversification. I mean, because you're 10 steps ahead of us. It's how's that saying go? Buy the dip, sell the news or whatever.
Mhm.
Like they're the ones giving you the news.
Yeah.
Like I get why they're not diversified because they're already 10 steps ahead of us.
Yeah.
But for the average person, having a little bit of diversification is helpful because you'll have like everybody that bought into REITs and Vici and O and all that stuff. Like it might not be a great year, but that was a great year to buy because it was so low
Mhm.
and it's going to pay you, like we've said it throughout this whole podcast, what you do today is going to pay dividends later on, pun
Totally.
intended.
Yeah.
You know, yeah. But yeah, I think, but getting too diversified, I think, is like we spoke about too, is like you can't have 39 different stocks.
Mhm.
Like, find a couple, you know, even if it is just having two, maybe what I'm doing is wrong and I only have one healthcare, but for me, it's just that's the one I believe in the most. If that one takes a dip, that one takes a dip, but I don't see that going anywhere in any near future.
Yeah.
So I'm okay with that decision with only having one, because now I can use money for something else elsewhere that may be a different play.
Yeah. Yep. Yeah, I agree. I don't. There's a lot of things in dividend investing that I don't agree with, but one thing I will say is that I don't know that there's many wrong answers in investing in general, much less dividend investing. I just think there's answers that are better. Like there might
Right.
be a better opportunity than the one you're in. Like AT&T and Verizon, I hate them. They're not great for me. You talked about selling them. It's not that AT&T and Verizon are bad for everybody. They're just not
Right.
good for me and they're not good for you, but they might
Yep.
be good for you later, or they might
Yep.
have been good for you before, but they're not good for you now. So it's one of those things where like talking about pivoting and changing and stuff like that. Like there's no one size fits all. Like there's not going to be a perfect strategy for every investor because there's different timelines, different risk tolerances, different amounts that they can contribute every month, like different knowledge levels, like all kinds of different stuff. So it's just about, like I said, and you talked about like figuring out your criteria, figuring out your level of understanding. Like I think it's Warren Buffett that calls it your circle of competence. Figure out
Yep.
what you know and stuff like that. Don't try to be, like I see Joseph Carlson on YouTube. He's got way more subscribers than me, way more views, makes way more money, has way more money in his portfolio. I'm not sitting here. How can I be more like Joseph? I'm just like, okay, what does Joseph do that's successful? What can I take from that? And like, how can I take the things that I do want to be like Joseph and do my own version of that and see if it works for me?
Yeah, absolutely.
But yeah, okay.
The grass isn't always greener on the other
Yeah,
side, man.
exactly. Yeah. And that's one of the things with like the YouTube channel. Like in these interviews, you guys get to see like me. Like none of this is scripted. I mean, I have my questions that I'm asking you, but me and you are just talking. In my regular videos, I'm trying to find the balance between like I want to write something because I ramble. If all my Power 5 videos would be 25 minutes long if I didn't write anything because I'd just be talking. But so like I have to script them, but I also am trying to find the balance of like I write the video and I'm just sitting here typing the video. I'm like, yeah, I would say something like that. And I type it, but then I have to record it and rehearse it and stuff like that. And like, it takes away a little bit of like who I am as a person. So I'm trying to find the balance of that. Like, I don't want to be like this guy that say me and you met on the street and we didn't do this interview. Like, I wouldn't want you be a subscriber of my channel. You see me on the street. You're like, you're not anything like your videos. I don't want to be like that. I want to be
Right.
myself. Like exactly how I'm in this interview is how I talk to everybody. I mean, I try to cuss a lot less in interviews. I think I've been good so far, but yeah, so it's just one of those things where that is a balance that I'm trying to do. I don't know how that has anything to do with what we're talking about, but anyway, okay. So 2 final questions. This last one, next one, I'm always interested to see what my guests say. So there's a lot of myths and misconceptions in investing, in dividend investing specifically. Are there any, especially with you being as big as you are on Twitter or as active as you are on Twitter or both? Are there any myths and misconceptions you hear all the time on the interwebs where like somebody says this about investing or dividend investing specifically where you're just like, that's just not true. Like, I don't know where you're getting your information. Like one that we always like hear is like that dividend investing's for like old people. And I'm just like that. Why? Like it's better when you start younger. Like why would that be for old people?
Yeah. I mean, I can't think of anything right off the bat per se. But I just think just the whole misconception of dividend investing in general, like that it's like you said, it's for old people. You don't care about anything but dividend yield and stuff like that. I mean, like we've went over so much different things just in this hour or so. It's like there's so many aspects to what goes into play into making a dividend stock valuable. I mean, it's the same people that had this conversation 10 years ago use Disney as an example. I mean, this is great, probably hit all their things, and then all of a sudden they drop their dividend, and now nobody wants to be a part of Disney. Well, is Disney going anywhere? Is the value? It's same thing Warren Buffett talked about all the time. If the stock drops, is the value of the company, is everything that you put into it, all the thought that all the processes that you put into it, is all still the same? Then it doesn't matter. You just lost out on some free money.
Yeah.
But that doesn't take anything away from that company if you still believe in it, and I think that's the misconception, is that most people think, oh, we're just slow rolling it here and we're just waiting for the compound interest. And we are, but there's a lot more to it. We don't always just invest in that. You have Tesla, I have Tesla. Like, it doesn't have to always be dividends. It doesn't have to always be 15% yield with MPW. It's like, and there's nothing wrong with doing that. I threw $100 into MPW because I knew that thing was either a hit or a miss, and it was a swing and a miss. But I'm not sitting there stressing out that, looking at that and seeing a 76% loss on it, because it's $100.
Yeah.
So maybe one day it does hit, and then it's worth $300. Cool. But if it's not, I didn't put in my whole entire account like I did with, I'm bag holding Riot for almost 2 years now. I believe in that company. It doesn't pay a dividend. I believe in that company long term, because I missed the boat on Bitcoin. So I'm looking at blockchains as a supplement to those. So I got into a Mara and a Riot. I got into both of those. I think now Mara is probably the better play after hindsight's 2020, but they'll go up together. If Bitcoin ever gets to that big number everybody's talking about, that play is it's gonna make me money, but that's the misconception. I think everybody thinks that, oh, it's just dividends and you're just worried about yield and you're just worried about this. And it's like, no, there's a lot more to it, man. And I think it's what we spoke about this whole entire time, man. It's just diversification, doing your due diligence, and believing in what you're buying, And if you don't, I'm a gambler, man. I love to play poker and I love to play roulette. So I will always, our next interview, whether it be 3 years, 5 years from now, what dumb play did you buy? Let me give you the list real quick. Hold on. Because I'm still going to do it.
Yeah.
Because I'm a gambler. I'm a gambling man. But now I've allotted a certain amount of my income to that. There's always going to be that fun money. So that fun money gets used for that. It could be a hit or a miss play, but I mean, that's life. It's life, man. It's the choices. And like you said, you just got to be able to deal with it.
Yeah. Yeah. And more importantly than than a lot of that stuff, I think the biggest thing is like I say, everybody's going to make the mistakes. The most important part of the mistake is if you can realize what caused the mistake. Don't say it was bad luck. Don't say it was bad timing. Don't say it was, woe is me, the world hates me, everybody's out to get me, whatever. None of that matters. What mistake did you make? Why did you buy it? Did you watch 4 videos in a row on SCHD or whatever? Whatever it was, like, what caused you to do this? Was that the right decision? Like you said, hindsight's 2020. So if you actually step back from the situation, get your feelings out of the way and just say, hey, I made a mistake. Why did I make this mistake? You can avoid making that same mistake again.
Absolutely.
Now you might have like the trends that you talked about, like being a risk taker and stuff like that, but like you can still take risk, but don't take that risk because that risk burnt you. So now you can take a different risk on the situation that you might not have done before and see if that one works out.
I think one of the things, you've probably said this. I think everybody said it. That anybody that's invested has said it. Man, as soon as I buy the stock, it just goes down.
Has nothing to do with me buying it.
It has nothing to do with you buying it, but it has something to do with the timing that you're buying. You just bought it because you're like, oh man, I heard Troy say this was great, so I'm gonna buy it now. Well, Troy's been in it for 3 years. Of course it's great. Of course he's got great returns. Like, you just bought it at the tailwind. It's not saying that it's a bad company, but what goes up must come down. And if you look and you zoom out on that chart, it's never going to consistently go up. You just happen to, he just made 120% gains. Of course he's going to make a video.
Yeah.
Of course everybody's going to make a video because SCHD is going through the roof. Well, now it's not going through the roof. It's kind of just sitting stagnant.
Yeah.
Like, nobody's making a video.
Yeah, there's a lot less SCHD videos right now.
Yeah.
Yeah.
This is the time to buy it then. Yeah. If you thought it was cool then, buy it now. And then you get to start that video 3 years from now being like, man, SCHD, blah, blah. And there's going to be another guy going, man, every time I buy it, it always goes down.
I'm down 16% on my SCHD.
Yeah.
Yeah. I'm going to start doing that. Like, if I ever get to the point where like YouTube's full time, I'm just going to make videos on my Biggest Loser.
That'd be cool.
Because like everybody's like, I would love to make a video right now on Costco, but like everybody knows about Costco. Costco's doing great. It's like freaking almost $700 a share, but like, cool. But like, what about Next Era Energy?
Yes.
Like
I didn't even mention. Yeah, I got a few of those, man.
Yeah.
I'm like,
that's my dog. Like, that thing sucks. I'm down almost 20% on that. Now, I was down like 27%. And in combination with it slightly going up in the past month or two, and me continuing to dollar cost average, my loss is getting less. And I do think like I bought NextEra Energy for a reason. It met all my criteria. And it's still, despite it having a 20% down, still outperforming the market over the past 10 years.
Yep. That's like my UPS right now too. I mean,
didn't that one just drop like a lot?
Yeah. And it's like, and that's one of those, I literally go back to being a dormant stock now. I instantly went in and I just lowered the percentage that I don't put any money into that. I don't think it's going to go away. UPS is not going anywhere.
Yeah.
The only way, and I'm not saying because it may or may not happen, but the only way that anything affects that company so drastically is if Amazon decides to pull out. Yeah. And they make their own UPS. But then that means FedEx taking a hit. That means the United States Postal Service is taking a hit. I don't think they're willing to do that. If anything, they buy those companies. Yeah. You know, and Amazon, they just get built into that. And then you don't have to worry about UPS because it's now an Amazon stock. Yeah. Like,
Amazon at that point will be like not only like e-commerce, but also shipping and logistics.
Yeah. I mean, I knew somebody that worked for the phone call service for UPS, and they said something like 70% of their revenues like at that point was through Amazon. Like Amazon's such a big player to them. So if they pull out, that's when I'm going to be like, okay, well, I'm going to just take my L here. But until then, there's a package that comes every single day to my house or the next door neighbor's house. I see that during this conversation, I've seen them drive by 3 times. Amazon ain't going nowhere. Yeah. UPS ain't going nowhere. So again, just believe in what you got and make sure you believe in it and make sure you do your due diligence, man.
Yeah. Well, I mean, you're doing a really good, like the wrap up question that I always like to ask is like, say somebody watching today's video, like say we inspired them to not only start investing, but to start dividend investing. Say there's a 13-year-old and they're like, wow, I only have to invest $56 a month from now until 67. So like, what tips would you give that person that's going to invest? They're going to do dividend investing. Like what tips would you, if you had to go back and tell your younger self, you're 18 years old, you're telling yourself with the knowledge you have today, what would you tell yourself?
I would say if you don't know anything, start with VOO, something that follows the market. And then, like I said, just look around your house. What's the most common products? See what you spend your money on. What do your friends spend their money on? You know, I mean, I started that way. And here's a company. I bought into Levi's. I'm strictly a 501 Levi's guy. I don't wear anything else or a specific color. I'm a minimalist in my own way. I wear a black t-shirt, same color jeans. Yeah. You know, I got the same boxers, everything's the same. Yeah. Wear a uniform. I bought into Levi's. I don't even think they're a company that you can buy into anymore. I'm not sure.
No, I got a free share from Webull for Levi. They actually pay a dividend too. I think it was like 45 cents or something, or maybe 45 cents was the total one. I ended up getting like 2 free shares of Levi's. Awesome. I think I sold out of that because I just wanted to. Webull, great platform if you know how to read all that. Webull is so complicated.
Yeah, I don't like it.
I got it because I was watching like YouTube Financiers or something, and they were talking about like Webull get a free stock, whatever. I was like, okay, I'll try it because I was at Robinhood at the time, and I was like especially coming from Robinhood. Robinhood's like the most simplified version of investing you're ever going to see. And then I went to Webull, and I feel like that's the most complicated version of investing you're going to see. I was like, what am I looking? I was like, I don't even know how to look at my money. Like, how do I know what stocks I have? So it was I don't know. I sorry to ruin your thing, but yeah.
No, you're good. I mean, it's just, if you don't know anything, get into something that follows the market because that's just historically going to give you a specific return. When you've done your research and you've done your due diligence and you've watched 1,000 hours of YouTube videos, then you can start branching off. I wouldn't, from my mistakes, I wouldn't go more than 5, 7, do your Fab 7 or whatever, the Magnificent 7, whatever it is. Find those, find your own personal Magnificent 7. Find out how diversified you want to be. Like, do you really care about health? Do you really care about finance? If not, then don't worry about those sectors. Put more stuff into consumer, put more stuff into tech, more into REITs. If you don't know what a REIT is, don't invest in it. If you don't know how a company makes money, don't invest in it. And other than that, just keep it like that's something I learned in the Marine Corps. Keep it simple, stupid. Yep. I mean, that's really all it comes down to. Start with a couple of ETFs or something like that, and then just slowly start branching off. Nothing has to be done all at once. And if you have the ability to do fractional shares, make sure you sign up for a broker that does fractional shares. TD Ameritrade is not one, even though they're the best platform, I think, personally, for what I do, day trading, swinging, and stuff like that. But it bugs me that I can't put in, $100 into one company, versus I gotta buy all $700 worth of Costco.
Yeah.
Like, that bums me out,
Yeah.
But you look at my other account, it's like, yeah, I'll buy $100 here, $100 there, and that thing's just slowly building up. Now I've got way more shares than one share.
Yeah.
But
I don't know. It's 2024. I don't know. I've been saying before, I don't know how any platforms or brokerages don't offer fractional trading now. Like that seems mind blowing to me. And also, I'm curious. I know it's already Robinhood's the one. They're always the pioneers for as much crap as they get. They're always the first ones to do something. Robinhood's already starting 24-hour trading on certain stocks. That's going to be next. Because we don't need the guys screaming around, running around New York, talking about this and that. Like, it's just all going to be online. So you're going to be able to buy, that's one of the draws of crypto that people like, is that you can just wake up at 3 a.m. and buy a Bitcoin or whatever.
That's where, for me, that's why I started getting into futures and starting to learn a little bit of Forex and stuff like that, is because it's like, I worked at a job where I had my own screen up and it was just running all day long. And my boss didn't care, because he'd come up, what's going on? Like, he'd check it out and be like, how are we doing today? And I'd be like, oh, I'd know more than he did. And he'd follow some of my advice. And then I go to a new job and they just get annoyed if I'm even on my phone, So it's like, now I can't do the trading that I want to do. So I'm like, well, how do I make money? Oh, I can make money if I wake up at 2 a.m. to go pee like I always do. I'm just check the London markets real quick, make a little quick trade, boom, go back to bed. I made enough money, and I think, like you said, 24-hour trading, that's the next thing. And you're starting to see it. The guy that, I don't know his actual name, but one of the guys that started Robinhood went to this neighboring school here in Virginia, in Pocosin.
Wow.
And I support locals, but that's one of those platforms that I don't use anymore because of being part of the whole ape gang and you stopping me the ability to free market trade. I think that there's so much, now that I'm learning, there's so much crookedness in this. So it's a matter of, while they're playing chess and you're playing checkers, you just got to make sure you're doing the right thing. And going back to everything we've said during this whole conversation and every other podcast you've had, it's just making sure you believe in what you're doing, believe in the company, doing your due diligence, and having faith, and believing in the long-term goal. And it's not about getting rich quick, it's fun, it'd be great, but when you get rich quick and you become a millionaire tomorrow, cool, that goal's done. What are you going to do then? If you look at most lottery winners, they're back to being a garbage man a year later because they spent all their money on strippers and cocaine. Cool.
Well, that's really what it is. It's like the discipline and the habits that you build by doing it slow and steady. That's what lasts you forever. Like even the money might not last you forever, but it's more likely to when you do it that way versus like if everybody could just take a pill and be ripped and jacked and whatever their high school weight was, people would still get fat, or people would still be out of shape, or they still wouldn't be whatever they want to be because they didn't build the discipline and the habits to get there in the first place. So like you adding $100 a paycheck into your portfolio, like that is the habit that's going to get you to where you want to be 20 years from now.
Yeah. And it's like, I look at, like, if we ever had another GameStop squeeze, like I said, I'm a gambling man, I'm in there, but I know when to sell this time and I know not to buy back in. And I'm going to use that quick money to put that money to good use. I got greedy and I started, buy, sell. And I started doing that. And I got playing hot potato. And I'm the only one holding a potato. Like, but if you look at things and you look at things as a long-term goals and stuff like that, if you were to give me $1 million when I first started investing in 2020, I would have never put it into stock market. I would have never put it into a dividend company. I would have never put it into this. I would have just went, what is moving the fastest right now? Let's dump the whole $1 million into that. Oh, that's GameStop. Cool. Let's put $1 million into GameStop. I probably would have made a bunch, but guess what? You would have lost even more.
Well, that's a really good way to put that. Like if you were given $1 million when you first started dividend investing in general, would you have more than you have today? Because the answer is
Yeah.
probably not. Because like
Yeah.
you would have just lost the same amount of money you lost before, but at a bigger
Yep.
scale because it's more money.
And now I look at it like Munger always said, the 100,000 is it's the hardest to get to. I know that's when everything, and I've told it to my wife, I'm like, we just got to get to 100, babe. We just got to get to 100.
The first
because
anything is the hardest.
Yeah.
The first dollar you made in passive income was the hardest. The
Yep.
first $10 you made in passive income is the hardest. It's
Yep.
the first, and like that's what he says, and like because at that the reason he did 100 is because of the compounding. At that
Right.
point, compounding on 100K is way more noticeable than $100.
Yeah.
But like literally, my first video was the hardest. My first interview was the hardest. This isn't your first interview, but like the first 5 minutes of this interview was the hardest, which is why we
Yep.
talked for 25 minutes before we even started recording. Because like I know there's nerves. When I did Dave's interview a long time ago, I was nervous, and I was like, I'm quite literally just talking to one person on the internet. Why am I so nervous? And
Yeah.
then like the first, so that I love that saying by Charlie, and it's just one of those things. Like the first, literally, and when you go to the gym, and the first day you go to the gym, that's the hardest. The first day on your diet is the hardest. It's the first everything's the hardest.
Yep.
So,
but it's just a matter of sticking with it, man.
Yeah.
And I mean, that's the thing. It's like, I know once I get to that number, and I could have been to that number if I wouldn't have made some dumb mistakes, but we all make mistakes,
Yep.
man. And you just have to be able to take those punches and keep moving on. Like I do jujitsu. It's like, man, I learned, don't put your arm out or that guy's going to grab it and he's going to snap it.
Yeah.
Like
Yeah.
you just you learn from mistakes. Don't touch the oven because it's hot. You know, I'm the guy that touched the oven and I've touched it. Like
Yeah.
I've learned. Now I tell other people, don't do that.
Yeah.
You know, learn from my mistakes. Do as I say, not as I do.
Yep.
You know, and it's like, let me be the martyr. Let me teach you through my processes and my mistakes. You know, if you were to give me $1 million then, would I have the same amount? No. Give me $1 million today, you will never talk to me again because I will not. My lifestyle would completely change. You would never know. If I hit the lottery, nobody would know that. I wouldn't gloat about it. The first person I would talk to is a financial advisor and figure out what do I have to do that would make me not have to work for the rest of my life. Even with just $1 million, it's possible.
Yeah.
You know, and $1 million is not enough. But if you started now, and I started that compounding interest now, because I didn't put the $6 in, well, now I don't have to worry about it. And you'll never have to, you have to know where you just have to learn from the mistakes, man.
Yeah.
And I think it's one of those big things that a lot of people don't do. You know,
Yeah.
Albert Einstein said insanity is the same thing happening over and over and over,
Yeah.
you know? So as long as you're not insane, it should be good, man.
Yeah. Well, that's one of the biggest draws between me making this series is just like I'm going to learn things from you today. You're going to learn things from me. And most
Absolutely.
importantly, the guests that watch the video, they're going to learn from my mistakes and your mistakes. And the idea isn't that they make the same mistake and be like, oh, I remember Troy talking about that. Or I remember Jay talking about that. The
Yep.
idea is they were like, I remember Jay said he lost $4,000 on that. Let me not do that. And like,
Yeah.
the idea is like, let us spend the money on our mistakes and you learn from the mistakes we spent. That's like, you're going to investing, you're going to make mistakes. Those mistakes are going to cost you money. The best kind of mistake to make is the one where somebody else spent the money to learn the mistake and you learn from their mistake for free. That's the best kind of
Exactly.
mistake. So like, that's one of the points of this video, other than it being easy to, you know, post and it's cool that I get to meet new people and stuff like that. Like that was one of the big draws is like, okay, everybody's going to make mistakes and you got to learn from them, but nobody said they need to be your mistakes.
Exactly.
And
Yep.
that's the thing. So, well, anyway, Jay, it's been a pleasure speaking with you today. I hope your nerves from Twitter weren't too bad and you, this was a really good time for you. Go ahead and send me a link with your Twitter. That'll be down in the description for anybody else if they want to give you a follow on Twitter.
Okay.
I know you post a lot of good content on there. But if you have any closing remarks, go ahead. Floor is all yours.
Appreciate you having me on, man. For anybody that's new and investing, come follow me on Twitter. I'm pretty active on there. I might slow down a little bit because I got the business coming up. But man, learn from my mistakes, learn from Troy's mistakes. Keep watching these videos. It's just like audiobooks, man. I listen to them nonstop. I don't necessarily catch everything from a 12-hour audiobook, but just keep listening. And the little nuggets that you hear, write those down. Take what we say with a grain of salt, but also take it with, you know, some emphasis
A
behind it.
grain
We're
of
not
gold
just
too. Also, a
yeah,
grain of
yeah.
gold.
I mean, we're not just blowing smoke up your ass. We're
Yeah,
telling you
yeah.
exactly what we went through. But I do appreciate you. I appreciate everybody that's watching it, and have a great weekend, brother.
And that's going to wrap up this week's discussion. I really hope you enjoyed my conversation with today's guest, and thank you for spending part of your day with us. Remember, if you want to be on your very own episode of Dividend Discussion, make sure you reach out via email at dividendobsession@gmail.com, and I'll be in touch. But until next time, see you.